like, share, and subscribe. Wishing you happiness and good luck every day.
Hello and welcome. Look, when the economy gets shaky, it's really easy to let fear take over. I get it. But the best defense isn't panic, it's knowledge. So today we're going to break down some timeless wisdom to help you navigate a downturn, not with fear, but with a solid strategy and a little bit of calm. You know, this quote really hits home, doesn't it? It was written way back in 1968, but it feels like it could have been written yesterday. It's a powerful reminder that this feeling of chaos and confusion we get during a downturn, well, it's nothing new. The real trick has always been finding clarity and seeing the patterns inside all that mess. All right, so here's our game plan for today. We'll start with the basics. What even is a bear market? Then we'll get into its anatomy, learn how to spot one coming, and figure out what to do when it's here. And we'll wrap up with what I think is the most important piece of the puzzle, the right mindset to get you through it all. Okay, first things first, let's get on the same page about what we're even dealing with here. The term bear market gets tossed around all the time, right? And usually it just ends up scaring people. So let's pull back the curtain and figure out what this beast really is. At its heart, a bear market is just a fancy term for a market that's heading down for a sustained period. And the most crucial thing to grasp is that this isn't some once-in-a-lifetime disaster. It's a natural part of the economic cycle, kind of like the seasons changing. Think of it as a necessary cool-down after things have gotten overheated. The real danger isn't the bear market showing up. The real danger is being caught off guard without a plan. Okay, now this number, this is a big one. 35%. Let that sink in for a second. Over the last 90 years or so, the market has been in a bear phase for more than a third of the time. So, you see, this isn't some freak event. It's a regular, recurring feature of the investment world. It's something we absolutely have to expect and prepare for. All right, so if these things are so common, how in the world do you prepare for them? Well, you start by understanding how they work from the inside out. You've got to know the anatomy of the bear. If you can learn its typical phases and its little tricks and deceptions, it's like having a map for a very, very tricky hike. Yeah, a bear market usually doesn't just drop on your head overnight. It tends to roll out in 3 phases. First, there's the abandonment of hopes. That's when everyone finally realizes the party's over. Then comes phase 2, when the hard numbers start to catch up. Company profits fall and reality bites. And finally, you get to the distress phase. This is when people aren't selling because they're scared, they're selling because they have to, just to pay the bills. Knowing which stage you're in can make a huge difference. And here, this is maybe the trickiest part of a bear market. It's what the experts call a secondary reaction, but I like to call it the bear's head fake. It's a rally, prices shoot up, everyone breathes a huge sigh of relief, and it feels exactly like the recovery has begun. You get so tempted to jump back in. But so often, it's just a track, a little breather, before the market heads down again. So the million-dollar question is, how do you tell the difference? Well, a bear market rally is just a temporary blip. It's all emotion, no real substance, like a safety valve letting off a little steam. A real new bull market, on the other hand, is built on something solid. It's a fundamental shift because the economy is actually getting better. You see real, sustained buying, not just a frantic, short-lived bounce. Okay, so how do we get better at this? How do we train our eyes to spot the difference between a trap and the real deal? It all comes down to learning to read the signs of a top, and just as importantly, the signs of a bottom. You know, before a market takes a dive, the warning signs are usually screaming at us. We just have to be willing to listen. Think about it. Every so-called expert is saying, buy, buy, buy. Your neighbor, who knows nothing about stocks, is suddenly giving you tips. Prices are just astronomically high. That's when you should be the most careful. It's that classic moment when everyone's feeling like a genius and the very idea of risk seems to have vanished into thin air. And on the flip side, the bottom of a market is the complete opposite. It doesn't usually arrive with a big dramatic bang. It's more of a whimper. It happens when every single news story is doom and gloom. Nobody wants to even talk about stocks anymore. The market is just dead. And that total apathy, is often the loudest signal that things are about to turn. The market starts to climb when everyone is too scared to even look. Okay, so seeing the signs is one thing, but what do you actually do? This is where the rubber meets the road. Let's get into the practical, actionable stuff, the core strategies you can use to survive. First off, you have to flip your entire mindset from offense to defense. Your number one job is no longer how much can I make? It's how do I protect what I have? It is all about capital preservation. From there, we can look at some more advanced tools, like short selling and also where to park your money. The places that let you actually sleep at night when things are going crazy. All right, let's just touch on short selling for a second. It gets a bad rap, and yeah, it can sound complicated, but really it's pretty simple. Buying a stock is a bet that it'll go up. Shorting a stock is just the opposite. It's a bet that it'll go down. It's a way to actually work with a downward trend instead of just sitting there and watching it happen to you. And I love this quote because it tackles a big misunderstanding head on. Some people think that being defensive or shorting the market is somehow wrong or unpatriotic, but that's just not true. Protecting your money isn't selfish, it's responsible. Think about it. A country needs people with capital to rebuild and invest when the recovery finally begins. Staying solvent isn't just good for you, it's good for everyone in the long run. And that brings us to what I believe is the most critical part of this whole discussion. We can talk about tactics and strategies all day long, but none of it matters without the right mindset. This isn't just about what's in your portfolio, it's about what's going on between your ears. So you've really got three types of people. You have the permanent bull, who always thinks things will go up forever and gets absolutely crushed when they don't. Then you've got the permanent bear, the doomsayer who's always predicting a crash and misses all the good times. The goal is to be neither. The goal is to be the realist. For realist understands it's all a cycle. They aren't married to one view. They're flexible. They follow the evidence and adapt because they know that nothing, good or bad, lasts forever. This quote, it's a bit intense, I know, but it perfectly captures that realist mindset when it turns contrarian. Buy when there's blood in the streets. It sounds grim, but what it really means is having the courage, and just as important, the capital, to act when everyone else is paralyzed by fear. It means being a buyer when everyone else is a seller. And you can only do that if you've done your homework, if you've stayed solvent, and if you recognize the signs that the cycle is turning. That's where real opportunity is born. So as we wrap this up, let's bring it all back to you. The question isn't, is the market good or bad? I mean, you can't control that. The real question you need to ask yourself is, who am I prepared to be? Are you going to be the eternal optimist, the constant pessimist? Or are you going to be the realist, the one who adapts to the world as it is, not as you wish it would be? Because ultimately, that choice is what will define your journey. We've all seen it happen. The market turns red, the headlines get scary, and you can just feel the panic in the air. But what if we looked at a bear market differently? What if we saw it not as some kind of random disaster, but as a predictable, normal part of the economic weather? Today, we're going to strip away all that fear, all the bad advice, and get to the core strategies for not just surviving a downturn, but maybe even thriving in one. Because let's be honest, the real test of an investor isn't how you do when everything's going up. It's how you navigate the waters when the tide goes out. I wanted to start with this quote from Schopenhauer because, honestly, it gets to the heart of what we're talking about today. We all have our own field of vision, right? It's built from our own experiences, our own biases. The big danger is when we start thinking that our little window is the whole world. So our goal today is simple. Let's shatter some of those limits. Let's expand our perspective way beyond the usual market myths. So here's our game plan. First, we'll take a look at how the rules of investing have changed over the years. Then we need to get super clear on our terms. What exactly is a bear anyway? From there, we're going to start busting some of the biggest myths that trap investors. We'll explore why market cycles are just inevitable, and I'll leave you with a really powerful tool to help you see the market for what it is. Not as a bull, not as a bear, but as a realist. All right, let's kick things off with a huge idea. The market is always changing. The strategies, the map that worked perfectly for your parents or grandparents, well, today, that same map might just lead you right off a cliff. Let's see what that actually looks like. Just look at this timeline. In only a couple of decades, the game completely changed. Back in the 50s, the advice was so simple. Buy the big, stable, blue-chip companies, and that's it. Just wait. But fast forward to the late 60s, and all of a sudden, you had to be an expert on wartime inflation. By the 70s, you had to understand global politics, OPEC, and currency markets. The takeaway is pretty clear. The world just gets more complex. What worked yesterday is never, ever a guarantee for tomorrow. You have to adapt. It's not just a good idea, it's the only way to survive. Okay, so before we can really dig into strategy, we've got to be speaking the same language. In the world of investing, fuzzy words lead to expensive mistakes. So let's get really precise about what we're talking about when we say bear and bear market. It sounds simple, right? But that last part, acts on that belief, is absolutely crucial. A bear isn't just some pessimist who's sitting around complaining. No, a bear is an active player. They're putting their money where their mouth is and making a bet that the trend is headed down. It's about action, not just attitude. And this whole idea goes way beyond just Wall Street. You can have a bear market in pretty much anything that people buy and sell. Your local real estate market, yep. The value of vintage cars, absolutely. It's a universal concept, a long period of time where prices are just falling. Now, this is a fantastic way to think about it, because not all downturns are the same. You've got your baby bears. These are those quick little dips. They feel scary at the moment, but they're usually over before you even know it. Then you have the mama bears. These are way more serious. They're painful, they last a lot longer, like that big slump in the mid-70s. And then you have the papa bears. These are the big ones, the generational game changers, like the Great Depression that literally reshaped the entire economy for a decade or more. Being able to tell which one you're in is a pretty vital skill. So this brings us right to one of the biggest mental traps for any investor, what I call the myth of permanence. It's this idea that you have to pick a side, you're either a bull or you're a bear, and you have to stick with it forever. It's just a really dangerous black and white way to see the world. You see these two characters all the time. On one side, you have the permanent bull. This person is always optimistic, convinced that every single dip is just a buying opportunity before the next big rally. Then, on the other side, you have the permanent bear. This is the person who's always screaming that the sky is falling, sometimes with this weird moral righteousness, almost like they think being prosperous is a bad thing. The problem? They're both wrong. They're letting their identity dictate their decisions, not the facts. And in the market, that's a surefire way to lose money. And that right there is the answer. That's the hero of our story, the realist. Look, the goal isn't to be an optimist or a pessimist. The goal is to see the market for what it actually is, right now, not what you hope it is. That flexibility, that commitment to reality over some ideology, that is the true winning mindset. I love this slide because it totally reframes the conversation. A smart bear isn't some grumpy doomsayer. More often than not, a smart bear is just a former bull who was paying attention. They saw the clouds gathering, and they were smart enough to grab an umbrella. The real winner isn't the person who's always bullish or always bearish. The winner is the chameleon, the investor who can change their colors when the environment changes. All right, now let's wade into some pretty controversial water. We're going to tackle a myth that's packed with emotion. It's this idea that there's something fundamentally wrong, maybe even un-American, about betting that the market will go down. So let's just put the question right out there. Is selling short, which is basically betting that a stock's price will fall, somehow an act of betrayal? I mean, you hear this all the time from TV commentators, right? They make it sound like you're rooting against the home team. But let's push all that emotion to the side for a second and just look at the cold, hard logic. Let's just walk through the facts. 1, it's perfectly legal and it's regulated by the SEC. If it was truly evil, it wouldn't be part of the system. 2, and this is a really powerful point, your most important duty as an investor is to stay solvent, to not lose all your money. You could even argue that's a patriotic duty. Why? Because when the next recovery comes, we need people with capital to fund it. Broke investors can't rebuild an economy. 3, you're not actually hurting the company itself. You're just making a bet against another investor who has a different opinion. And finally, number 4, short sellers actually help stabilize the market. In a real panic, when everybody is selling, who's on the other side of that trade buying? It's the short sellers. They have to buy to close their positions. They create a natural safety net that can stop a free fall. Okay, that brings us to what might be the 4 most dangerous words in all of finance. This time is different. It's the theme song of every single market bubble in history. It's the belief that somehow we've figured it all out and entered a new era where the old rules of economics just don't apply anymore. This old saying is the perfect cure for that kind of thinking, because while all the details change, the technology, the companies, the politicians, the one thing that drives market cycles never does: human nature. Greed and fear have been with us forever, and they're not going anywhere. I mean, just look at this list. History is littered with the ghosts of new eras. The Romans were convinced their empire would last forever. In the 1920s, a top economist famously said that stock prices had reached a permanently high plateau, all thanks to amazing new tech like the car and the radio. He said that in 1929. The modern version of this is the idea that governments and central banks have mastered the economy and can prevent recessions forever. History teaches us one thing very clearly: you should be very, very skeptical of claims like that. So you have to ask, why does this myth keep popping up? Well, it's pretty simple. The people in charge, politicians, CEOs, TV personalities, they have a built-in reason to be optimistic. Their job depends on keeping the good times rolling. That's exactly why the best investors learn to think like a contrarian. They learn to be skeptical, especially when everyone else is cheering. All right, this brings us to our final and most important section. We've talked a lot about history and psychology, but how do you actually use this realist mindset day to day? We need a tool, something practical, to help us find our way. And for that, we can go all the way back to one of the founding fathers of market analysis, Charles Dow, the guy who started the Wall Street Journal. Over 100 years ago, he noticed this thing he called the great law of action and reaction. Today, we just call it the 50% principle, and it is still an incredibly simple, incredibly useful rule of thumb for figuring out which way the market is really heading. Now, this is a fantastic tool because it helps take the emotion out of your decisions. Let me just walk you through it. So, scenario 1. Let's say the market runs up from 8,000 to 10,000. It then has a little pullback. The halfway point of that run-up is 9,000. As long as the market stays above that 9,000 level, the bull market is probably still healthy. But, scenario 2, if that correction cuts down below the 50% mark, below 9,000, that's a huge red flag. The main trend has likely flipped from up to down. Now it works the other way too. Scenario 3, after a nasty bear market, things start to recover. If that recovery rally manages to gain back more than half of everything that was lost, that's a very strong sign that a brand new bull market is starting. And finally, scenario 4, if a bear market has already wiped out more than half of the entire previous bull market's gains, you better brace yourself. The odds are very high it's going to go even lower. Look, it's not a crystal ball, but it's a powerful framework for judging the probabilities. If I had to boil this entire philosophy down to just 2 words, it would be these, from the ancient Greek philosopher Diogenes: be a cynic. Now, he didn't mean you should be a miserable person. He meant you should be a questioner. You should challenge what everyone else just accepts as true. Be the person in the room who always asks, why? And so, here we are, right back where we started, with Schopenhauer's warning about our own field of vision. The next time you're looking at the charts, the next time you hear some expert on TV telling you with 100% certainty what's going to happen next, I want you to just pause and ask yourself this one simple but really profound question. Am I seeing the market as it truly is, or am I just seeing the limits of my own view? The discipline to answer that question honestly might be the single most valuable investing skill you ever develop. After nearly 2 decades of an incredible bull market, it's really easy to get comfortable, to feel like the good times are just the new normal. But history has this powerful lesson for us, one that, if we're being honest, most of us have collectively decided to forget. So today, let's dive in and really look at what the past is trying to tell us about the market cycles that are, well, inevitable. The Roman statesman Cicero said this more than 2,000 years ago, and boy, has it never been more true for investors. To really get a handle on the markets, you can't just look at the last few years. You have to look back, way back, and learn from what others went through. I want you to think about this for a second. The huge majority of fund managers out there today, they started their careers after 1980. They have zero personal memory of that brutal, wealth-crushing, inflationary bear market of the 1970s. In fact, when that thing kicked off in 1966, most of them weren't even born yet. Their entire professional worldview has been shaped by one of the greatest periods of growth in history. And that lack of real-world experience, well, it creates a massive blind spot. The very idea that we could get stuck in a grinding, multi-year global bear market, it's just not something most modern investors can even wrap their heads around. But history is screaming at us that it's not a question of if, but when. And here's the crazy part. Our own amazing technology can actually be our worst enemy. We've got this incredible stock market software that can spot patterns and compare today's charts to the past. But it kind of makes us lazy. It encourages us to compare the what, the shape of the lines on a graph, without ever digging in and asking why. The unique cultural, political, and social stuff that actually made those patterns happen in the first place. So this reliance on just matching patterns without any of the context builds up this really dangerous illusion. When we put all our faith in what the computer spits out, we can come to some spectacularly wrong conclusions. The comparison between the 1929 and 1987 crashes is the perfect example of this. I mean, just look at these numbers. It is uncanny. In both 1929 and 1987, the market started to crash exactly 55 days after it hit its peak. The size of the initial drop? Almost identical. If you were just a piece of software, you'd be flashing red alerts saying history is repeating itself. And this eerie similarity led to a belief that basically became gospel on Wall Street. And this was the big lesson everyone took away from '87. The Fed jumped in, slashed interest rates, and boom, the market came roaring back. The thinking became, hey, we've cracked the code. We've got the tools now to stop another Great Depression. But is that what really happened? Turns out, that's a dangerous myth. Because if the Fed just cutting rates was some kind of magic bullet, why didn't it work after the dot-com bubble burst in 2000? The Fed cut rates more aggressively then than at any other time in its history. And yet, there was no V-shaped recovery like in '87. Why? Because the problems under the surface of the economy were way deeper, and that's something a chart alone is never going to tell you. And this just perfectly illustrates what Mark Twain was talking about. Relying only on statistics, on the numbers crunched by a computer, can be the best way to lie to yourself. We have to look past the data and start thinking about the market in a much deeper way. Over in Europe, they often have a different philosophy, one that's more focused on preserving capital than just chasing fast profits. They call it taking a view, and it's less about the day-to-day noise and more about developing a real long-term perspective on the whole world. So what does that actually mean, taking a view? Well, it means you're looking past the charts to build a multi-year idea of where the world is actually going. You're thinking about social changes, political tensions, the big economic currents flowing underneath everything. It's about understanding the whole story, not just the data points. An investor who was taking a view back then would have seen that 1929 and 1966 weren't just market dips. They were signs of deep, systemic problems that would take more than a decade to sort out. But they also would have seen that 1987, as scary as the numbers looked, was mostly a Wall Street freakout. The real economy, Main Street, was still pretty healthy. And telling the difference between a sick economy and a healthy one, that's everything. Okay, so with that new way of thinking in our back pocket, let's go back and look at the hard data. Just how often do these big downturns really happen? The answer might actually shock you. 35%. That's right. Over the last 90 years, the market has been in a bear phase for more than a third of that time. So for every 2 steps forward, we've taken at least 1 step back. These are not rare once-in-a-lifetime events. They are a regular, predictable part of the landscape. Just look at this timeline. The panic of 1907, the Great Crash, the downturn before World War II, the oil crisis, the dot-com bust. On average, a major bear market has come along every 4 years. That long, amazing bull run of the 90s, that was the exception, my friends, not the new rule. Forgetting how often this happens is one of the biggest mistakes you can make. And this chart really drives it home. If you're a committed buy and hold investor, at any given moment, you've only got about a 2 in 3 chance of not being in a major downturn. You know, those aren't exactly amazing odds for a strategy that's all about just sitting tight and waiting. So now that we see just how common bear markets really are, it's time to take a hammer to some of the most dangerous myths that investors cling to when the tide finally goes out. We've all heard it, right? Don't worry, it'll bounce right back. This idea of a quick, sharp, V-shaped recovery is so appealing. It makes it sound like if you just have the stomach to hang on, you'll be back to where you started in no time. But history tells a much, much longer story. 26 years. That is how long it took for the Dow Jones to finally get back to its 1929 peak. Just think about that. That's someone's entire working career, a whole generation just waiting to break even. And this isn't some dusty piece of ancient history either. It took 16 years for the market to truly break past its 1966 peak. Quick recoveries are the lottery ticket, not the retirement plan. And that leads us straight into the second and maybe the most damaging myth of all, the one that became absolute dogma during that long 90s bull market, that all you have to do is buy good companies and just sit on them, forever. The problem is, this strategy has never really been stress tested by the people who preach it the loudest. This quote from an investor during the dot-com bust, it just says everything. Without a game plan for when things go south, buy and hold becomes freeze and hope. This guy was totally paralyzed by his losses. He couldn't even bring himself to look at his statements, let alone make a clear decision. That's not a strategy, that's a trap. Okay, so if the old myths are broken, what's the alternative? We need to build a totally new investment mindset, a more resilient framework that prepares us for how markets really are, not the fantasy version of a never-ending party. So here's what that looks like. First, you have to be flexible. The world changes, and your strategy has to be able to change with it. Second, have contingency plans. The time to figure out what you'll do in a fire is not when the building is burning down. Third, look beyond the charts and actually take a view. And finally, trust your instincts. Now, this isn't about guesswork. It's about that deep-down judgment you get from experience, from doing the homework. It's what the source material calls unarticulated knowledge. Because here is the one thing history absolutely guarantees. The next bear market won't look like the last one. It's not going to fit the neat patterns from the software. Armies are always training to fight the last war. And way too many investors are only prepared for the last bear market. So the real question you have to ask yourself is, armed with the real lessons of history, will you be ready for the next one?
All right, let's talk about the stock market. It can feel like pure chaos, right? Especially when things get ugly. Today, we're going to cut through all that noise. We're looking for the timeless guideposts that can help us navigate the roughest part of the journey, the bear market. It's a world just full of opinions and hype, but there are some solid principles that can really act as a compass when things get choppy.
Ralph Waldo Emerson absolutely nailed it with this one. Making a fortune takes boldness and caution, sure. But keeping it, he says that takes 10 times as much wit. And he's right. It can feel pretty easy to make money when the market's flying high, but that's really just half the battle. So this whole explainer, it's about that wit Emerson was talking about. It's about the skill you need to hang on to what you've earned, especially when the tide, and believe me, it always does, turns. It's all about preservation. And maybe more importantly, about thinking clearly when everyone around you is completely losing their cool.
So let's get into it. The Wall Street noise machine. Why is it that modern financial commentary seems almost designed to confuse you? Well, here's the thing. A big part of the problem is that Wall Street isn't what it used to be. It's really shifted gears, It's gone from being this place of, let's say, sober analysis to basically a 24/7 entertainment channel. The goal now? It feels like it's all about putting a positive spin on everything. Just keep investors reassured, keep them in the game, instead of, just giving them the cold hard facts.
And you can see this change perfectly in the words they use. Just look at this. Back in the 80s, when the savings and loan industry was in trouble, they called it what it was, a bailout. And the market got it. That's a bad sign, a sign of failure. But fast forward to today, a very similar situation, say for the airline industry, gets a total rebrand. Now it's an economic stimulus package. And what happens? It's spun as a reason for the market to go up. It's the same event, folks, just wrapped up in language that's meant to make us all feel better.
And this creates a really dangerous story, a narrative that we all get fed. Think about it. When things go wrong, it's never anyone's fault. It's always some external factor, right? But when things go well, then the credit goes to a new government program or a Fed decision. What this does is it completely severs the link between what's happening in the real economy and how the market is performing, and it leads to what the source material here calls a culture of victim investors. And the result of all that? You get markets that feel totally unpredictable, which ironically leads to way more volatility and way more panic when that cozy narrative finally falls apart.
Okay, so with all of this noise, this constant spin, it's just so easy to lose your way. So it really makes you wonder, right? In the middle of all this chaos, what's the one fundamental truth that everybody seems to forget?
Well, the answer is actually pretty simple. We just have to go back to basics, back to Charles Dow himself. When he created his famous average over 100 years ago, he saw it as a barometer, a measurement of the country's economic health. He got this one simple thing right. Stocks aren't just tickers on a screen. They represent real businesses with real people and real customers. In the long run, it's the health of the economy that drives the stock market, not the other way around. And this right here is the bedrock idea that's been almost completely lost in all the modern noise.
And hey, this isn't just some dusty old theory. Let me give you a powerful example. During the massive crash in the 1930s, you had one of the richest men who ever lived, John D. Rockefeller, who decided he was going to stop the bleeding. He went out and started buying up huge chunks of his own company's stock, telling everyone how valuable it was. And for a couple of days, he actually managed to slow down the fall. But he couldn't stop it. He couldn't reverse the massive tide of a failing economy, because in the end, economic reality, it always wins, no matter who you are.
Okay, so let's get practical. If we anchor ourselves to that core idea that the economy is the engine, then we can start looking for actual signs. So how do you recognize when the party might be winding down? What are the signs that a bull market is getting tired?
Well, the first clues are usually psychological. It's all about the mood. You'll see investor sentiment is just incredibly bullish, even when the actual economic numbers are starting to look a little shaky. Confidence, both for consumers and investors, is at an absolute peak. You turn on the TV and literally every single expert is bullish. There's this total agreement. And if the market does dip a little, oh, it's just temporary. It's a buying opportunity. That kind of unanimous optimism where you can't find a single skeptical voice, that's a huge classic warning sign.
All right, let's talk numbers. Let's talk about valuation. One of the oldest tools in the box is the price-to-earnings ratio, or PE ratio. Now, to know if things are expensive, you first have to know what's normal, right? So if you look back since 1870, the historical average PE is about 13. All that means is that on average, investors have been willing to pay $13 for every $1 of a company's yearly profit. So think of 13 as our baseline, our historical anchor.
But at market peaks, that number gets completely unhinged from reality. Take the dot-com bubble back in 2001. At its absolute peak, the PE ratio shot up to between 25 and 35. I mean, that's more than double the historical average. Prices were just completely leaving actual earnings in the dust. When you see a number that far out of whack with history, that's a massive red flag. It's telling you the market is probably way overvalued and running on nothing but fumes.
You can also spot warning signs just by looking at how the market is behaving and what's going on with debt. There's a thing called churning, and that's a big one to watch for. It's when you see tons of trading volume. I mean, lots of buying and selling, but the overall market just isn't going anywhere. It's kind of like a car spinning its wheels in the mud. Lots of energy, no forward progress. At the same time, you'll see a huge spike in debt of all kinds. Credit cards, mortgages. People are borrowing like crazy because they're convinced the good times are here to stay. And this often spills over into things like wild speculation in real estate.
And finally, you have the Fed. It seems like almost every single major bull market in history ends with some kind of speculative fad. The pattern is always the same. It starts with a real, genuine innovation. Think about tulips, or railroads, or the internet in the 90s. But then it gets blown way out of proportion. It morphs into this almost religious belief in a new era. Investors completely stop caring about whether a company actually makes money. They're just buying the story. And when you see that happening, that's a pretty sure sign you're deep in the bubble stage.
All right, so the top's in, the bear is here, now what? Well, it might feel like just a chaotic free-for-all, but it turns out that bear markets often have a predictable structure. They have a roadmap. And we can thank a guy named Robert Rhea for this, a really sharp advisor from way back in the 1930s who mapped it all out for us.
So Rhea broke it down into 3 phases. Phase 1 is what he called the abandonment of hope. That's that first really sharp drop where the whole optimistic story from the bull market just shatters. Then comes phase 2. This is the long, slow grind down, where the market starts to accept the reality that businesses are earning less money. And then you get to phase 3, the most painful part, distress liquidation. This is when people aren't selling because they want to, they're selling because they have to. And here's the really important part. Rhea pointed out that these phases get interrupted all the time by these big, sharp rallies. We call them bear market rallies. And they trick so many people into thinking the worst is over and a new bull market is starting.
Okay, so how do you know when this whole painful process is finally coming to an end? Well, just like there are signs of a top, there are absolutely guideposts that can help us spot the bottom, or at least get a sense that the worst is probably behind us.
So what are we looking for? Well, it's pretty much the exact opposite of what you see at a market top. At the bottom, the mood is just awful. The news is terrible. It's all unemployment and terrible economic data. Every single forecast is pessimistic. Confidence is completely gone. And here's the key. Nobody cares anymore. The public has totally lost interest. Trading volume is super low. Often the market will make its final new low on almost no volume at all. Why? Because everybody who wanted to sell or had to sell is already out. There's just nobody left to panic.
And from a financial perspective, everything's basically on sale. Stocks are cheap, you'll see really low PE ratios and high dividend yields, assets like real estate are down, and you can't give property away. And where is all the money? It's crowded into safe stuff like government bonds. And what that tells you is there's a ton of what they call latent buying power. It's just cash, sitting on the sidelines, scared. And that cash is the fuel that will eventually power the next bull market.
So we've covered a lot of ground here, right? We've talked about sentiment, valuations, how the market moves, but the source material for this whole explainer argues that the single most important guidepost, the most critical asset you have, has absolutely nothing to do with charts or data. It's something way more personal.
This quote from way back in 1931 just hits it right on the head. Solvency is entirely a matter of temperament and not of income.
Think about what that means. It's saying that your emotional control, your ability to stay rational when the world is going crazy with either panic or euphoria, that is way, way more important than how much money you make or how smart you think you are.
So, what this all comes down to is this. The ultimate guidepost is your own rational mind. All those external signs we've talked about, they're basically useless unless you can filter them through your own clear thinking. You have to be able to see the facts for what they are, to separate the signal from all that noise, and then act based on what the evidence is telling you, not what the screaming crowd is doing.
Which brings us to one of my favorite old Wall Street sayings. Don't confuse brains with the bull market. It is so easy to feel like a genius when every stock you buy just goes up and up. But your real skill, your real temperament, that doesn't show up during the good times. It shows up when the party's over and it's time to clean up the mess. It's just a great reminder to stay humble, stay disciplined, and never, ever let a bull market make you think you're invincible.
So I'll leave you with this final question. We've gone over the guideposts, the history, the principles. But when the moment actually comes, and it will, when the market is just completely swept away by fear or by greed, will you be able to think for yourself?
When a major crisis hits the world stage, what's your first gut reaction? For most of us, it's to pull back, right? To protect what we've got. But when it comes to our investments, is running for the hills really the smartest play? We're going to dig into that very question, this complicated dance between global chaos and your portfolio, and ask if maybe, just maybe, true safety is found by looking outward, not inward.
You know, this line from the poet Saadi, written way back in the 13th century, just hits the nail on the head for investing today. Think about it. The global market is this huge, sprawling landscape, and trying to navigate it without a strategy, without some real knowledge, well, you're that bird without wings. It's not just a little risky, you're pretty much guaranteed to not get off the ground.
So this really gets to the heart of it, doesn't it? When things get scary out there, when headlines are screaming, is the best defense really to just cash out of everything foreign and bring all your money back home? It's a powerful impulse, driven by fear, for sure. But let's actually kick the tires on that idea and see if it holds up.
Okay, let's dive right in. To figure out if pulling your money home is the right call, we have to look at this massive tug of war that's always happening. On one side, you've got this short, sharp shock of something like a terrorist attack. And on the other, you have this incredibly deep, powerful current of globalization. It's a real clash of titans.
So here's what people are really worried about. Could some terrible event actually slam the brakes on the world economy and throw it into reverse? I mean, could we see a repeat of the 1930s where every country just threw up walls and trade barriers? Because that would be a catastrophic unwinding of everything that's been built over the last, 50-plus years.
Well, the short answer, according to the analysis, is a pretty resounding no. The engine of globalization, all those supply chains and interconnected economies, is just too big and too embedded to be easily reversed. I mean, just look at Europe. They've been dealing with terrorism for over 40 decades, and it hasn't stopped their markets from growing. That same resilience is what's expected to play out on the global stage. Think of it this way. Every investor is living in two worlds at the same time. On the left, you've got the day-to-day noise, fear, volatility, political drama. It makes for great headlines. It causes the market to jump and dip. But on the right, you've got the deep, slow-moving ocean currents. Things like economic fundamentals, population growth, real innovation. And over the long haul, it's those deep currents that determine your destination, not the choppy waves on the surface.
So if we accept that globalization is here to stay, what does that actually mean for how you build your portfolio? Well, it leads to a conclusion that might feel a little backwards at first. In today's unstable world, having 40 to 60% of your investments in foreign markets is actually seen as the wise move. Why? It's simple: diversification. It means you're not tying your entire future to the risks and cycles of just one country. It's an admission that sometimes the best growth and even the safest havens might be somewhere else.
All right, so that's the why. But that brings up a really practical question, right? If investing abroad is so important, how on earth do you actually do it without it being a huge headache? So let's talk about the tools of the trade, the things that make global investing something that pretty much anyone can do.
Let's be honest. The idea of buying stock directly on a foreign exchange can sound like a total nightmare. You're thinking about currency conversions, different trading hours, weird regulations. It feels like you need a PhD in international finance just to get started.
But the good news is there are much, much simpler ways to get the job done.
And the number one tool for most people is something called an American Depository Receipt, or an ADR. Now, the simplest way to think about an ADR is like it's a claim ticket. A big U.S. bank goes and buys a giant block of shares in, say, a Japanese tech company. They hold on to those shares, and then they issue these receipts, these ADRs, that you and I can trade right here on U.S. stock exchanges.
And the process really is that straightforward. The actual foreign stock sits in a vault at a bank somewhere. The bank then issues the receipt, the ADR, and then you can buy and sell that ADR on the New York Stock Exchange or the NASDAQ, just as if it were a share of Coca-Cola. It's priced in US dollars, you get dividends in US dollars, it's designed to be easy.
So what this all boils down to is that ADRs are basically your passport to investing in some of the biggest and best companies all over the world. They give you all the benefits of global diversification without any of the logistical nightmares. For most retail investors, this is the key that unlocks the door to a truly global portfolio.
Okay, so we've talked about going abroad for growth, but investing overseas isn't just an offensive strategy. It can also be a really powerful defensive one. So now let's switch gears and talk about how you can use foreign assets as a hedge, a way to protect your wealth when things get rocky, like in a bear market or during a bout of high inflation.
You know the old saying, when investors get nervous, they flock to gold. It's the ultimate safe haven asset. But here's a little twist you might not have thought about. Many of the world's biggest and best gold mining companies, they aren't American. We're talking about giants based in Canada, Australia, and South Africa.
And this is where it gets really strategic. First off, you can buy most of these big foreign miners as those easy-to-trade ADRs we just talked about. But here's the real kicker, and this is a key insight for timing the market. The shares of these mining companies often start to rise before the price of physical gold itself takes off. They can act as an early warning signal that big money is getting nervous and moving into defensive assets. That's a huge advantage.
All right, but let's say your biggest fear isn't necessarily a stock market crash. What if you're more worried about the cash in your wallet? What if you see high inflation coming and you're afraid that the value of your own currency is about to get eaten away? Well, this is another classic case where looking abroad can be a very powerful defensive move.
You've basically got two paths you can go down here, and they are very different. For the average person who's just trying to preserve their capital, the safer, simpler route is opening a bank account in a foreign country with a stable currency. On the other hand, for the active, nimble trader, there's the world of currency futures. This is where you're making leveraged bets on where a currency is headed. Much higher potential reward for sure, but also way, way riskier.
So if you're thinking about that safer path, banks in places like Switzerland and the Netherlands have been doing this for centuries. They're built for international clients. You can often open an account right through the mail or with a simple wire transfer. Now, the minimums aren't trivial. They can start around 25 grand and go way up into the millions. And one last pro tip from the source material. If privacy is a major concern for you, you'll want to deal directly with the bank's head office overseas, not its U.S. branch.
We've covered a lot of ground, talking about strategies and tools, but now I have to kind of be the bad guy for a minute and inject a serious dose of reality into this conversation. Because when a truly nasty, prolonged bear market really sinks its teeth in, all the normal rules can go right out the window.
This quote from the old market analyst Humphrey Neal is just a fantastic warning. What he means is that a strategy that seems totally logical and healthy in normal times, like diversifying into foreign stocks, can still get you killed in a real panic. When a major crisis hits, all correlations tend to go to one. In other words, everything starts falling together, and there are very few places left to hide.
And that brings us to the most important point of all. In a vicious bear market, your entire mindset has to shift. The game is no longer about trying to make a profit or find growth. The game becomes about one thing and one thing only: preserving your capital. It's not about winning anymore. It's about surviving to play another day.
And you see this shift happen everywhere. Companies slam the brakes on expansion plans and start cutting back. They become less global, not more. And as a recession spreads around the world, all those attractive foreign opportunities we were talking about start to dry up fast. In that kind of environment, cash is king. And those defensive assets, like the gold mining stocks we mentioned, become one of the very few bright spots in an otherwise dark market.
And that leaves us with one last question. A question for you to think about. When the next downturn inevitably comes, how will you react? Will you see the rest of the world as a source of diversification and maybe even safety? Or will that primal instinct to pull everything back home be too strong to ignore? The right answer? Well, it's going to depend on your knowledge, your preparation, and when it comes right down to it, your own stomach for risk.
Let's talk about one of the most dangerous moments in investing. You're in a deep downturn, a bear market, everything's red. And then suddenly you get this sharp, powerful rally. It feels like a lifeline, right? The relief is huge. But what if that lifeline is actually a trap? Today, we are diving deep into the bear market rally. It's a phenomenon that's going to force you to turn your thinking completely upside down. And, this quote from J.K. Galbraith really just hits the nail on the head. Because in a bear market, the thing we think we know, that a big rally means the worst is over, is often the very thing that gets us into a world of trouble. It's our own certainty that becomes the biggest risk. So here's the bottom line. We are all conditioned to see green on the screen, to see upward movement as good news. But when the primary long-term trend is down, that exact same rally is often just a temporary break. It's a deceptive pause before the next and often more painful leg down. It's a classic wolf in sheep's clothing. All right, so here's our game plan. We're going to start by really defining what these deceptive rallies are. Then we'll get into their hidden purpose, why they're kind of like the market's safety valve. After that, we get practical. How do you spot the turning points? We'll dig into the psychology of hope that makes these things so convincing. And then we'll wrap up with what you can actually do about it and why this old school wisdom is more important than ever. Okay, first things first, we have to completely flip our normal market vocabulary. In a good market, a bull market, we call a dip a reaction. But when the main trend is down in a bear market, everything gets inverted. The real term, the one that comes from classic Dow theory, is a secondary reaction. And this isn't just some random bounce. It's a significant, important upward rally that is fighting against the main downward current of the bear market. And honestly, getting this definition straight is the key that unlocks this whole concept. And get this, these rallies aren't rare. They aren't some freak event. They are an expected, baked-in part of every single bear market. They are the rule, not the exception. I mean, think about the Great Bear Market from 1929 to 1932. It had at least 7 of them. They are a feature, not a bug. So, if these things are just a normal part of the process, what are they for? Why do they even happen? Well, to really get this, we got to turn to one of the great market thinkers, Robert Rea. He came up with this brilliant analogy. This is just a perfect way to picture it. Think of a market that's just been plunging, day after day. It's like a steam boiler building up an incredible amount of pressure. The selling just goes too far, too fast. The secondary reaction, that rally, it acts like a safety valve. It lets off that steam. It releases that pressure before the whole system just blows apart. It's actually a necessary mechanism. Now, this safety valve idea, it's really doing 2 jobs at once. First, it corrects a market that has just become totally oversold. The selling has just gotten way ahead of itself. And second, it serves to punish the speculators on both sides of the trade. It especially tends to trap amateur traders who pile in way too late, whether they're buying the rally or trying to short it. Okay, all this theory is great, but here's the million-dollar question, right? How in the world do you spot one of these things? How do you tell the difference between a dangerous bear market rally and the real start of a new bull market? Well, let me tell you, it is incredibly difficult. You see, unlike the end of a correction in a bull market, which often finishes with a huge, high-volume panic selling day, the bottom of a leg in a bear market can be weirdly quiet. The selling just kind of peters out. This makes trying to call the exact bottom based on volume almost impossible. But while the start is sneaky, the end of the rally often gives us some pretty big clues. All right, now this slide is absolutely crucial. The start of the rally is often violent. It feels like it turns on a dime. Why? Because it's not usually driven by smart long-term investors. It's often kicked off by professional short sellers, people betting on the price to fall, who are now buying back their shares to lock in their profits. That forces a rapid spike. The end, though, is totally different. It tends to be telegraphed. You'll see a peak on big excitement and high volume, but then the market tries to rally again and crickets. The activity just dries up. It gets dull. And that dullness, that is the #1 warning sign. And don't just take my word for it. This observation comes from the man himself, Charles Dow, over 100 years ago. He figured out that while a quiet, dull market can be a launchpad for the next move up in a bull market, in a bear market, dullness is ominous. It's the quiet before the next storm. It means all that buying pressure has been used up and that primary downward trend is getting ready to take over again. So if the signs are there, then why do so many people, I'm talking smart people, professionals even, get fooled by these rallies time and time again? Well, the answer has less to do with charts and numbers and everything to do with plain old human psychology. It's a really good question, isn't it? I mean, put yourself in that situation. After weeks, maybe months of watching your portfolio shrink, you are psychologically starving for good news. Your desire, your hope that the worst is finally over becomes this incredibly powerful, blinding force. This rally feels like the answer to all your prayers. And this observation from Robert Rea is just brilliant. It shows how market sentiment becomes this perfect contrary indicator. Right at the bottom, when the despair is thickest and the rally is about to start, pretty much all the experts are bearish. Then, as the rally goes on, recapturing huge chunks of the previous losses, that same crowd gets overwhelmingly bullish. They start declaring a new bull market has begun, which is usually the kiss of death, right as the rally is about to fail. Now, part of what feeds this bullish fever is this common but really dangerously oversimplified rule of thumb. You hear it all the time. A bear market rally will typically retrace between 1/3 and 2/3 of the prior decline. And so when a rally blows past that 50 or 60% mark, people just capitulate. They throw in the towel and assume it has to be the real deal. But let's look at the actual history that Rea put together. That classic 1/3 to 2/3 zone, only about 1/3 of rallies actually stop there. Now look at the right side of this chart. A jaw-dropping 22% of all bear market rallies retrace more than 70% of the last decline. Some of them retrace almost the entire move down before they finally fail. Relying on that simple rule of thumb is a recipe for absolute disaster. And if you need any more proof of just how powerful this psychological illusion is, listen to this. This is Robert Rea himself talking about the huge rally in 1930, right after the 29 crash. Even this guy, the master of Dow theory, who understood this stuff better than anyone, he admitted that the hope was so infectious. The talk of a new bull market was so loud that he got panicked out of his short positions and took a huge loss. That's how powerful this is. Okay, so we understand what they are, why they happen, and why they're so deceptive. Now for the most important part. What do you actually do about them? Because these rallies aren't just a trap to avoid. They are a massive strategic opportunity if you know how to play them. The source material gives us a really clear action plan. So one by one. First, bail out. This is your get out of jail free card. The market is giving you a gift. Use these better prices to sell the losing stocks you should have sold earlier. Second, for more aggressive folks, the peak of that rally, when you see that high volume followed by dullness, is a prime time to think about short selling. Third, be agile. Just trying to grit your teeth and ride out a bear market is a recipe for pain. These swings are just too big. And finally, and this is the big one, remember what's at stake. If you don't use this rally to sell, you risk taking a bath on the next huge wave of selling. All right, let's wrap this all up by taking a step back and looking at the big picture. You know, it's really fashionable today to dismiss any market analysis from before, say, the internet as being old and irrelevant. But the principles we've been talking about today are rooted in something that never ever changes: human nature. And this is maybe the most powerful idea in the whole text. In science, all progress is built on the foundations laid by giants like Newton, right? No physicist today would say Newton's laws are too old to matter. Of course not. And yet, in the financial world, there's this constant temptation to say this time is different. But the technology changes, the companies change. But the raw emotions of fear and greed that drive these cycles, they're absolutely timeless. So, I'm going to leave you with this question to think about. The next time you find yourself in a nasty bear market and a powerful, convincing rally takes hold, and you hear all the experts on TV declaring the bottom is in and a new bull market has begun, what will you see? Will you see a genuine recovery? Or will you recognize the telltale signs of a secondary reaction, a second chance to protect yourself before that false dawn fades away? Knowing the difference, well, that's everything. Thanks so much for joining me. Welcome to The Explainer. You know, when a market is falling, it feels like pure chaos, right? Just a sea of red numbers. But what if there's actually a predictable structure hidden inside all that noise? Today, we're going to uncover the anatomy of a bear market, breaking it down into these distinct phases people call legs. And understanding this pattern, well, it can give you a clear framework when everyone else is just lost in the chaos. Henry J. Kaiser once said, "Trouble is only opportunity in work clothes." And that, right there, is the perfect way to look at this. See, instead of just reacting with fear when things head south, we're going to put on our work clothes, roll up our sleeves, and really take the trouble apart to understand its mechanics. That's always the first step towards seeing potential opportunities that almost everyone else is going to miss. So, here's our game plan for today. First, we'll nail down what a leg even is. Then, we'll dive right into the human psychology that really drives these phases. After that, we'll look back at some history, at the market's footprints, unpack the technical reasons markets move in these waves, and then we'll put it all together in a practical way before zooming out to see how this all fits into the bigger picture of market cycles. Okay, first things first, before we can start spotting these patterns, we need to be absolutely crystal clear on what we're talking about. We need to be on the same page with what a leg of a bear market actually means. So let's establish a common definition. And this is the key thing, right? A leg isn't just a random bad day or a week of selling. It's a significant, identifiable phase of the decline. You can think of it like a chapter in the larger story of a market downturn, a really sustained downward push before you get some kind of temporary pause or even a little recovery. And while every bear market definitely has its own unique personality, the classic textbook structure, well, it tends to unfold in 3 major downward waves. Believe it or not, it's a surprisingly consistent pattern, and understanding this number, 3, is really the key to the whole framework we're building today. So why 3? Is there something magical about that number? Well, no, not really. It turns out that each leg is actually tied to a very distinct psychological and economic shift, a change that investors and, the broader economy go through during a downturn. This slide really gets to the human story behind the charts. Leg 1 is that initial shock, that uh-oh moment when everyone finally admits the party's over, and those euphoric predictions were, well, just plain wrong. Then comes leg 2. That's when the bad news becomes undeniable. Company earnings are dropping, economic reports are bleak, and the market starts pricing in a real recession. But leg 3, that's when it gets personal. It stops being about fundamentals and starts being about people needing cash for real-world expenses, forcing them to sell even their best stocks. It's about kitchen table decisions. Okay, so that's the theory, but does it actually hold up in the real world? Let's put on our historian hats for a minute and go look at the market's footprints to see how these legs have actually played out over the decades. If you look back at the really big crashes from 1929 all the way up through the early 60s, you see this remarkably consistent pattern emerge. Each time, it starts with a loud, high-volume crash. That's the panic selling. But the actual bottom of that leg, the point of total exhaustion, that came later, on way less volume, as the sellers just kind of ran out of steam. But markets don't stay the same forever. They evolve, and those predictable patterns of the past, they don't always hold. Starting around the late 1960s, something fundamental began to shift in how these market legs behaved. And this slide shows that shift perfectly. Before the late 60s, you were looking for the selling to get quiet, for the volume to just dry up at the bottom. But after that period, the game changed. The news signal that a leg was ending wasn't a lack of selling, but a sudden, powerful surge of buying volume on the way back up. The bottom actually became louder, not quieter. So what happened? What caused this massive shift? Well, it wasn't just one thing. First, you had governments taking a much more active role in trying to manage the economy. Then you had the explosion of institutional money, these massive pension and mutual funds whose buying and selling could literally move the entire market. And then you layer on top of it all the 24/7 financial news cycle, which started pushing traders to act now, every single day. All right, let's dig a little deeper into the actual mechanics of all this. Why do these waves, these legs, even happen in the first place? Well, there's a core principle at play here, and it all comes down to momentum. There's this fantastic analogy for it. A market that's in a strong uptrend has a certain stride, right? It has momentum. A sharp fall completely breaks that stride. The market can't just hop up and immediately sprint to a new record. It has to find its footing again. And that whole process of stumbling and trying to get back up is what creates these waves. Maybe the best way to think about it is like an actual tidal wave. A major market drop isn't a single event. It's a massive release of energy. The first wave hits and hits hard. It might pull back for a moment, but that doesn't mean the danger is over. The underlying force is still there, which makes follow-up waves not just possible, but pretty probable. That's just the nature of downward momentum. Okay, we've got the theory down, we've looked at the history. Now for the most important part. How can we actually use this legs framework to make sense of what we're seeing on a chart in real time? This simple chart gives us a clear playbook. Look here, that first big drop from A to B, that's your leg one. Then you get a bounce from B to C. Now, this is often called a sucker's rally because it fools people into thinking the worst is over, but it's usually temporary. The real confirmation of the downtrend comes when the selling starts again and the market breaks below that previous low point at B, starting leg 2 from C to D. That sequence is the absolute classic signature of a downtrend. Okay, now if you remember one thing from this section, make it this. After that first drop to point B and the little rally up to C, the moment of truth is what happens next. If the market falls again and breaks below that first low at point B, that is a powerful, powerful confirmation. It's telling you that the bounce was fake and that the bears are still firmly in charge, which signals the next leg down is starting. So, if that's how a downtrend continues, how do we know when the pain is finally over? Well, we basically look for that exact pattern to reverse itself. Instead of making lower lows and lower highs, the market will finally make a higher high. And then when it pulls back, it makes a higher low. That little sequence is the first solid piece of evidence that the bears have lost control, and a new uptrend might just be getting started.
All right, let's pull the camera all the way back for our final point here. Understanding these individual legs is super useful tactically, but their true power comes when you place them within the much larger, unwavering context of market cycles.
And history could not be clearer on this. I mean, just look at the data. Major bear markets are almost never a one-and-done event. They always have a minimum of 2 distinct legs. And in some of the most extreme cases, you can get as many as 8 of them. The key takeaway here is that a bear market is a process, a marathon. It's not a single one-off shock. I want to leave you with this incredible quote from Bernard Baruch. And think about this. He wrote it in July of 1932, at the absolute rock bottom of the Great Depression, when it feels like the sky is falling and it will never, ever stop. The simplest and most powerful reminder from history is that declines eventually always do.
And that's really what this framework is all about. It's not a crystal ball. It's not going to help you pick the exact bottom to the day. What it is a map. It's a tool that lets you step back from the daily panic, figure out where you might be in the larger cycle, and replace those emotional reactions with some structural awareness. It gives you balance, it gives you perspective, right when it's the hardest to find.
So we'll leave you with this thought. By understanding the anatomy of a market cycle, you're no longer just a passenger getting thrown around on a chaotic roller coaster. You can actually start to read the tracks up ahead. The question isn't just, what will the market do next anymore? The real question is, how will you see it differently? And what will you do with that new perspective? All right, let's dive right in. Today, we're tackling a topic that's absolutely crucial for any investor: how to see a bear market coming, and more importantly, how to make it through in one piece. We're going to give you a set of real practical tools and a clear strategy to help you navigate what can feel like a pretty chaotic time in the market. Let's get started. You know, I love starting with this quote from way back in the 17th century because it just hits the nail on the head. When it comes to investing, especially when the market is dropping like a stone, our biggest enemy isn't the lack of information. It's usually our own mind, our own willpower. We tell ourselves it's impossible to navigate a downturn, but that's just an excuse. Today, we're going to prove that excuse wrong. I mean, it's a familiar feeling, right? The news is all doom and gloom. You look at your portfolio and it's just a sea of red, and you feel like you're just caught in a hurricane with absolutely no control. Well, that feeling of being powerless, that's exactly what we're here to fix. The goal isn't to perfectly predict the future, but to replace that fear and helplessness with a structured, confident game plan. So here's our game plan for this explainer. First, we'll talk about what I call the bear market fog and why our usual methods don't always work. Then we'll find a clearer path forward using technicals. After that, we get to the really good stuff, building your essential market toolbox. Then we'll see how to combine those tools into a personal index. And we'll wrap it all up with the most important part, developing the mindset of a true analyst.
Okay, so let's just get real for a second about what a market downturn feels like. It's confusing, right? It's disorienting. It's what we're calling the bear market fog.
Look, most of us are taught to invest using what's called the fundamental approach. You analyze a company's earnings, their balance sheet, news about a hot new product. And in a nice, steady market, that's perfectly fine. But in a bear market, it can be a trap. Why? Because you never really know if you have all the facts. Bad news gets hidden, false rumors spread like wildfire. It's literally like you're driving down a highway at full speed in a thick fog, trying to navigate by only looking at your car's dashboard. It's a recipe for disaster. So if we're in this fog, how do we find our way out? Well, we need a different set of instruments. We need ones that look directly at the road itself, at the market itself. And that's where the technical approach comes in, offering a much, much clearer view. And this slide just lays it out perfectly. On one side, you've got the fundamental approach, which is so vulnerable because it relies on outside information that could be incomplete, late, or just flat out wrong. But then you have the technical approach. The source actually calls it scam-proof. And why is that? Because it only uses public data, price and volume. The price is the price, the volume is the volume. There are no secrets, it's all right there for everyone to see, which gives you a level of confidence you just can't get otherwise. Now, technical analysis isn't some kind of magic crystal ball. It's really the art of measuring the market's own behavior. It's about listening to the story the market is telling us through its two most basic ingredients. What's the price and how much is being traded? By studying those two things, we can start to forecast the most likely direction prices are headed next. Okay, now for the fun part. This is where we actually get our hands dirty. We're going to build your toolbox. I want you to think of yourself as a master craftsperson, and you need the right tools for the job. But before we open up that toolbox, let me give you a piece of advice that's absolutely golden. Your goal is not to have 100 different complicated indicators. No, it's about mastering a handful of really solid, reliable tools. You want to know them inside and out, how they act in different situations. So let's build that essential starter kit. Our very first tool, and you could argue it's the most important one, is the advanced decline line. It sounds fancy, but it's super simple. Each day, you just take the number of stocks that went up and subtract the number of stocks that went down. That's it. This gives you what's called market breadth. It tells you what the entire army of stocks is doing, not just the big generals you see in the Dow Jones. It reveals the true health of the market under the surface. Next up in the kit, new highs versus new lows. This one gives us a fantastic read on the market's momentum. Are more stocks breaking out to new peaks, or are more of them falling into new valleys? By looking at a simple 5-day average of this, you can spot trouble. For example, if you see a major index like the S&P 500 hitting new highs, but the number of individual stocks making new highs is shrinking, that's a huge red flag that the rally is running out of steam. Okay, this next one is fascinating. It's called the Odd Lot Balance Index, and it basically tracks the behavior of the smallest mom-and-pop investors. And here's the thing. Historically, this group has had famously bad timing. They tend to get super confident and buy right at the top, and then they panic and sell everything right at the bottom. So the pros use this as a contrary indicator. When you see the little guys start selling in a panic, it might just be the best time to start buying. And now we get to volume. The source material calls this the most important, least understood, and worst measured factor in the whole market, and I completely agree. Think of it this way. Price tells you what happened. Volume tells you how much conviction was behind it. It's the emotional fuel. A big price move on huge volume? That's a strong, confirmed move. A price move on tiny volume? That's suspect. It might not be real. And this is the perfect illustration of the story that volume tells. Joseph Granville broke down a bear market into 4 phases. Just look at the psychology here. In phase 1, the market starts to drop, but on light volume. Why? Because it's only the pros, the smart money, who are quietly selling. The public still thinks everything's fine. But by phase 3, the public is in a full-blown panic, dumping everything they own on massive volume. That's the selling climax. And guess what? That's the exact moment the pros step back in to buy from them. Volume literally shows you the transfer of stocks from scared hands to strong hands. Okay, our final tool for the starter kit is a classic, the 30-week moving average. This is just a super simple visual way to see the market's long-term trend. As a general rule of thumb, in a healthy bull market, prices will stay above this line. But in a bear market, the price will stay below it, and the line itself acts like a ceiling. So when prices are finally able to punch through that ceiling and stay above it, that's often a really powerful sign that the worst is over and the trend is changed for the better. So we have our tools. Awesome. But you know, a toolbox full of shiny instruments doesn't build a house, right? You need a blueprint. You need a strategy. So let's talk about how to turn these individual tools into a real decision-making plan. And here is that blueprint. It's a simple 5-step method. First, you pick the handful of tools that you really get. Second, you do your homework. You look back and see how they acted at past market turning points. Third, you give each tool a weight. A tool that's been right 8 out of 10 times gets more votes than one that's only right 6 out of 10 times. Fourth, every week you do a tally. How many points are bullish, how many are bearish? And finally, and this is the most important part, you stay patient. You only act when there's a really clear, strong signal from your index. And trust me on this, the power of this kind of systematic approach is incredible. Even a simple index you build yourself forces you to be objective. It takes the emotion out of the picture. It puts you in the driver's seat, analyzing the data for yourself. And that simple act immediately puts you light years ahead of the millions of investors whose only strategy is to panic based on what some shouting head on TV just said. So we have the tools, we've got the strategy, the last piece of the puzzle, and frankly, it might be the most important piece, is getting your mind right. This is what really separates the amateurs from the pros. And here are 2 critical warnings right from the source. First, these tools aren't a magic formula that works perfectly every time. An indicator might signal a turn, but that turn could take days or even weeks to fully play out. You have to think in terms of probabilities, not certainties. Second, and this is so important, you have to work to develop a feel for the market. It comes from experience, from looking at the charts every day. It's truly an art that's built on a foundation of science. Now, if you only remember one single thing from our entire discussion today, please let it be this. The absolute key to success with this approach is patience. You don't jump on a weak signal. You don't act when it's a 50-50 call. You wait. You wait until the evidence is overwhelming. You wait until your index is practically screaming at you. That's when you act, and you act with confidence. And really, that's what this all comes down to. The market is not just random noise. It's constantly telling a story. It's a story about human emotion, about fear and greed and hope and panic. The story is always being told. The only question is, have you built the toolbox and developed the mindset to be able to listen?
You ever have that feeling you're investing, you've got your playbook, your set of rules, and then suddenly it's like the whole game changed and nobody sent you the memo? The tools you trusted, the indicators you watched, they just don't seem to work anymore. Well, today we're going to dig into exactly why that happens. We're going to uncover how some of the most fundamental market tools literally change their shape when the weather turns from sunny to stormy. Let's get into it.
You know, it's pretty incredible that this was written way back in 1712 because it absolutely nails the psychology of the market. What Addison is getting at here is that our mood, our whole perspective, can shift with something as simple as the weather. And it is the exact same thing in investing. A long bull market feels like nonstop sunshine, and we act like it's never going to end. But the second the clouds of a bear market roll in, our whole perception shifts, and so does the meaning of all the data we're looking at.
I just love this analogy. It's so spot on. We all know someone like that, right? Their knee starts aching and, rain is on the way. Well, some of our most trusted market indicators are just like that. They work perfectly fine when the sun is shining, but just before a big financial storm, they start sending out these weird, confusing signals. And if you're not prepared to interpret them differently, they can lead you completely astray.
And that really brings us to the core of the problem, what I'd call the bull market illusion. And we've all been there. It's that long, easy period where it feels like you just can't lose. Every decision feels like the right one, and we get lulled into thinking that our simple, go-to strategies are just going to work forever.
I mean, think about it. In a strong uptrend, what works? Buy the dip? It's a genius move every time. Following momentum works like a charm. Pretty much every indicator you look at is just confirming the positive trend. It creates this really comfortable feeling of, well, blissful ignorance. We start thinking we've got these foolproof formulas, but what's really happening is the good weather is making every single tool in the shed look like a brilliant invention.
So what happens when that good weather finally breaks? This is the moment where your entire toolkit can feel like it's just fallen apart. The thing is, the indicators don't just stop working, their very meaning can flip on its head, pointing you in the completely wrong direction right when the stakes are the highest.
Okay, so let's start with one of the most basic, most fundamental indicators there is, volume. All it does is measure trading activity. Simple, right? Generally, we look at volume to confirm the conviction, the real power behind a price move.
Now this right here, this is where things get really eye-opening. The source material for this explainer states that a staggering 98% of investors keep using their bull market rules for volume long after a bear market has started. Just let that sink in for a second. That means almost everybody is misreading one of the most basic signals the market sends. And that, Well, that can lead to some absolutely brutal mistakes.
And this chart just lays it out perfectly. In a bull market, if the price is rallying on huge volume, that's great. It's confirmation. Everyone's excited and jumping in. But in a bear market, a massive volume spike on a day the market is crashing isn't confirmation. It's the opposite. That's panic. That's capitulation. That's the sound of everyone throwing in the towel at once. And on the flip side, the end of a bear market often isn't some big, dramatic, high-volume reversal. It's usually marked by a period of extreme dullness, just quiet, low-volume trading where the selling has finally and completely exhausted itself.
All right, let's grab another tool from the box that totally changes its shape, short interest. Now, in simple terms, this is just a count of how many people are betting that a stock's price is headed down.
So here's the critical shift in thinking you have to make. In a bull market, the common wisdom is that a big short interest is actually a positive thing. They call it fuel for the fire, because every single one of those short sellers has to eventually become a buyer to close out their trade. But in a bear market, that logic goes right out the window. Those short sellers aren't trapped. They are, as the source puts it, invested with the trend. They're winning, and they are in absolutely no hurry to buy back those shares.
And really, why would they? The market is going their way. They're just riding that primary downtrend for all it's worth. A falling market is their profit zone. And some of these traders will hold those short positions for months, or, believe it or not, even years, just waiting for a clear sign that the big trend is turned. So let me be really clear about this. When you see short interest hitting a new high in a bear market, that is not your cue to buy. More often than not, it means the smart money is just adding to their bets that prices are going even lower.
Okay, for our last example, let's look at market breadth. A common way to measure this is by looking at the daily list of stocks hitting new 52-week highs versus those hitting new lows. This gives us a peek under the hood at the market's internal health. Is the whole army advancing, or just a few generals?
Now, the change in how you read this is subtle, but it is so powerful. In a bull market, it's easy. We want to see more and more stocks making new highs. It confirms the trend is strong. But in a bear market, we're hunting for a divergence. So picture this. The S&P 500 makes a scary new low for the year. But on that same day, you look at the new highs list, and instead of 0, you see a small but resilient number of stocks still hitting new highs. That's a huge clue. It tells you that even as the main index is falling, some stocks are starting to bottom out and show strength. It's an early warning sign that the market is starting to heal from the inside out.
Now look, this isn't just some abstract theory I'm talking about. History is absolutely packed with examples that prove these principles are market reality. Let's actually walk through a case study from probably the most infamous market crash of all time.
This timeline from the Great Crash is just a masterclass in how to think during a bear market. Look at this. In May of '31, the Dow had already been crushed, and short interest was huge. Those shorts were proven right as the market got cut almost in half again by December. They took some profits, but here's the key moment. When the market staged the little sucker rally into 1932, they didn't get scared and run. No, they reloaded. They re-established their short positions, betting that the primary downtrend was still in force. And they were absolutely right, as the market then took its final soul-crushing dive to the bottom in July. They were on the right side of the trend for years.
Now let's look at a guy who just got it. This is a quote from a brilliant market analyst named Robert Rea, writing 1 month before the final bottom of the 1937-38 bear market. Pay attention to his language. He isn't trying to be a hero and call the exact bottom. He's describing the character of the market, its personality. He's saying it's entering that final exhaustive phase.
And guess what? He was right on the money. So how did he do it? It's because he wasn't just staring at one indicator and following a rigid rule. He was looking at the entire context. He could see that after a devastating crash, stocks were fundamentally cheap. The Dow was yielding over 7%. He understood that the market was just emotionally spent. He understood the bigger picture, something a simple formula could never ever do.
So, what does this all boil down to? What's the big takeaway here? It's this. Surviving, and maybe even prospering, in a bear market isn't about finding some secret new set of tools. It's about a fundamental shift in how you think.
This quote from the source material, for me, is everything. It's the whole ballgame. You cannot just follow a set of rules like there's some kind of unbreakable law. You have to put in the work to understand the why behind what the market is doing. At the end of the day, thinking for yourself is the single most powerful tool you have.
So let's try to boil this all down into a new mindset, a new mental model with 4 simple steps. First, always know the weather. Step 1 is just asking, are we in a bull or a bear market? Second, question your tools.
Don't just assume they work. Actively ask, what does a spike in volume really mean in this environment? Third, become a student of history. The patterns are all there. Past bear markets are the best textbook you'll ever find. And finally, number 4, the most important one. Think for yourself. Build your own case, understand why you believe it, and you will be miles ahead of the 98% who are still playing by the old rules.
So I'll leave you with this question. The tools on your charting platform, the indicators, the data, they're not going anywhere. They'll always be there. The real question is, are you flexible enough to change how you interpret them when the market season changes? Because in this game, that adaptability, that is everything.
You know, have you ever wished you had a crystal ball for the market, just to know for sure when the next big boom or the next bust is right around the corner? It's something we all want, right? This desire to find some kind of predictable rhythm in what feels like total economic chaos. But the real question is there actually a code to crack, or are we just chasing a ghost? Today, we're going to try and decode the very complex world of market cycles.
I think we should start with this fantastic bit of wisdom from Winston Churchill. It just perfectly sums up how tricky prediction really is. I mean, anybody can sound like a genius explaining what happened yesterday, right? But telling us what's going to happen tomorrow, that's a whole different ballgame. This really sets the stage for what we're going to explore. A healthy dose of skepticism, but also some genuine curiosity.
So here's our game plan for today. First, we're going to look at why we're so drawn to these prediction theories to begin with. Then, we'll put a very famous and famously wrong cycle theory under the microscope. After that, we'll talk about a much better way to think about how markets behave, why today's world is just fundamentally different, and we'll even dip our toes into the science of chaos. And don't worry, we'll wrap it all up with a practical guide on how you can actually use this stuff.
All right, let's jump right in. Section 1, the allure of prophecy. What is it about the idea of a predictable future that we find so irresistible, especially when it comes to money?
It's really just human nature, isn't it? We are hardwired to look for patterns. When the world feels random and chaotic, we search for formulas, for rules, for anything that gives us a sense of control and order. The idea that there might be some secret mathematical key to unlock the future, well, that's a really powerful and honestly a very comforting thought.
And that brings us to the biggest question of all, the one that's really at the heart of our entire conversation today. Can something as messy, as human, as emotional as an economy, can it really be measured and predicted with the kind of precision you'd find in a math equation? Or is life just not that simple?
Okay, so to see this whole desire for prophecy in action, let's look at a case study. We're going to really put this idea of perfect, repeatable cycles to the test by examining one of the most famous theories out there, the Kondratiev wave, and see how its predictions actually held up.
So, this idea came from a Russian economist, Nikolai Kondratiev. It was born in the 1920s, a time of huge scientific optimism, and the core belief was that history moved in these long, predictable waves of boom and bust. If you could just map that rhythm, you could basically project the future with scientific accuracy. I mean, it was an incredibly ambitious idea. But here's where it gets really interesting. Look at the track record. The theory said the 1930s depression would be even worse than it was. Wrong. Then it called for another massive depression in the 70s. Didn't happen. Then again in the 80s. Nope. And yet what's amazing is that despite these huge obvious misses, the theory keeps coming back. People just can't let go of that dream of finding the magic formula.
Okay, so if this idea of a rigid, perfect, repeating cycle is a bust, then how should we think about historical patterns? Is there maybe a better metaphor, one that actually fits the messy reality of the market?
I think this chart just brilliantly lays out the mental shift we need to make. Instead of thinking about a wheel turning perfectly on the same path over and over again, I want you to picture waves hitting a beach. See, every wave is similar to the one before it, but no two waves are ever exactly the same. There's a pattern, a recurrence, but there's also constant dynamic variation. It's an evolving process, not a fixed mathematical equation. And this isn't just some random metaphor we came up with. It actually comes from the work of a historian named David Hackett Fisher. In his book, The Great Wave, he makes a powerful case that this more fluid, dynamic model is a much more accurate way to understand the big shifts and price revolutions that have happened throughout all of human history.
Now, we've got to add another layer of complexity to this whole thing. Because even if we start thinking in terms of waves, just comparing the economic waves of today to the ones from, say, the 19th century, well, that's a huge mistake. Something fundamental has changed the game completely.
I mean, think about it. How can you really compare the price of wheat when it was harvested by a guy with a horse-drawn plow to its price today with GPS-guided combines and computerized farms? Or the cost of a quill pen versus a laptop? The context, the technology, it's so wildly different that these one-to-one historical comparisons, they start to fall apart.
And the real earthquake here, the thing that changed everything starting in the 1980s, was the desktop computer. Just think. In the old days, by the time economists could manually gather all the data and analyze it, the crisis they were studying might have already burned itself out. But today, we have real-time data. Governments and central banks can see a problem and intervene almost instantly, which completely changes the shape, the speed, and the duration of these economic waves.
But here's the catch. This incredible new power for governments to step in and tweak the economy can create a really dangerous false sense of security. It can make the public start to believe that big, scary risks are a thing of the past, that the experts have got it all under control. But when you try to fight the natural tides of a dynamic system like an economy, sometimes you just end up creating even bigger, more unpredictable problems down the road.
Now, to really wrap our heads around why exact prediction is so darn difficult, we're going to step outside the world of economics for a moment. We're going to turn to a really profound and frankly cool field of modern science.
Now, the name chaos theory is a little misleading. It's not about things being totally random. It's about how unbelievably sensitive and interconnected complex systems are. And an economy, with billions of people making billions of decisions every single day, is pretty much the definition of a complex system.
You've probably heard this famous analogy before, the butterfly effect. And what it really means is this. To predict the future of a complex system perfectly, you would need an infinite amount of data about its starting point. If you miss one tiny detail, the flap of a single butterfly's wings, that tiny error can grow and ripple through the system until your entire long-term prediction is completely and utterly wrong.
Okay, so after all of that, what's the final verdict? If perfect cycles are an illusion and the future is, scientifically speaking, unpredictable, should we just throw our hands up and ignore history altogether? No, not at all. We just need to be smarter about how we use it.
Here's the practical takeaway. You have to treat the study of historical cycles as one tool in a much larger toolbox. It's not a magic key. Use it to spot the broad, repeating patterns in human psychology. You know, things like fear, greed, euphoria. People's emotional reactions to booms and busts are remarkably similar across the centuries. But never, ever expect it to give you a precise date on a calendar.
There's this old Wall Street saying that just absolutely nails it. After a period of crazy excess, you can be pretty confident a painful correction is coming. That's the what. But trying to predict the exact timing, the when, that's the part that humbles everybody.
So the bottom line is this. The goal isn't to find some magic 9.3-year cycle in the price of semiconductors. The real goal is to understand the big picture, to see the whole forest. It's about recognizing that human beings, in the aggregate, tend to react to similar situations in similar ways. Use that broad understanding as a guide, but don't get lost down in the weeds trying to measure the exact distance between every single tree.
And we'll leave it with that final thought. The patterns are absolutely there. The waves of human behavior, of fear and greed, they do come back again and again. But the trick is that every time they reappear, they're wearing a different disguise, shaped by new technology and a new global context. The real skill, then, isn't about finding a formula. It's about learning to recognize the old patterns dressed up in their new clothes. Thanks for joining me.
All right, let's dive right in. Today, we're going to get to the very heart of market analysis. We're going to decode the language the market speaks by taking a close look at two of its most powerful tools, a theory that's over a century old but still acts as our economic compass, and the charts that give us a roadmap for every single move. Now, before we get into any charts or theories, we have to start with this. This is a powerful warning from the man himself, Charles Dow. And what he's saying is, the biggest risk you'll ever face in the market, it's not a bad stock, it's you. It's that stubborn part of your brain that refuses to admit it's wrong. Pride makes you blind, and a blind trader is a broke trader. That's exactly why we need objective tools to cut through our own biases. So here's our game plan for today. First, we'll grab Wall Street's oldest compass. That's Dow theory. Then we're going to look under the hood at its engine, the confirmation principle. After that, we're shifting gears to the market's roadmap, the charts. We'll see how to paint the picture with different types of charts, and then, and this is the really important part, we'll learn how to read the human story behind all that data. Okay, let's pick up our first tool. When you hear Dow theory, you might think, wow, that sounds Old? And you'd be right. It's been around for over 100 years. But listen, don't ever mistake old for obsolete. This theory is more like a battle-hardened veteran that has seen it all, guiding investors through every kind of market you can imagine.
And let's get one thing straight right away. Charles Dow wasn't trying to build a system to predict what Apple or Tesla would do tomorrow. No, his goal was way, way bigger. He wanted to create a kind of barometer for the entire U.S. economy. He wanted to know if American business was healthy or sick. The fact that it ended up being an amazing tool for calling major market tops and bottoms, well, that was just a very powerful side effect.
You really have to look back at its roots to get it. Dow had this brilliant, simple idea. You've got the industrial companies, the ones making all the stuff. And then you've got the railroad companies, the ones shipping all that stuff. Put them together and you get a full picture of the economy. Sure, the names have changed a bit. Railroads are now transports, but the core idea, it's exactly the same. An economy isn't healthy just because factories are busy. You have to get those goods to the people who buy them.
And that leads us directly to the absolute core of the theory. This is the mechanism that makes it all work. It's a beautifully simple, elegant idea called the confirmation principle. It's all about making sure that two completely different parts of the economy are singing the exact same tune. And when they are, you better pay attention.
Think about it like a big truck. The industrial average, all those companies making things, that's the engine. When the industrials hit a new high, it means that engine is roaring, production is booming. But what good is a roaring engine if the wheels are stuck in the mud? That's the transportation average. They're the wheels. For that truck to actually move forward, the wheels have to be turning just as fast as the engine. If the engine is revving, but the wheels aren't moving, you've got a problem. That's a classic warning sign.
So here's how it plays out. Nice and simple. Step 1. One of the averages, say the industrials, makes a big move, hits a new high. That's the initial signal. But, and this is key, it means nothing on its own. Step 2 is confirmation. The other average, the transports, has to do the same thing pretty soon after. If it does, boom, you have a confirmed valid trend. But if it doesn't, if you get what's called a divergence, that's a huge red flag. The theory is screaming at you that the first move was a head fake and it's not going to last.
You know, in the 90s, during the dot-com boom, all the experts said this theory was dead. They said, we're in a new economy. We don't ship physical goods anymore. Transports don't matter. Well, history had a funny way of proving them wrong. Think about it. After 9/11, when did the real recession fears kick in? It was only after the airlines, a huge part of the transports, started to go down. And even better, this old theory was flashing a bear market warning sign way before the tech bubble finally burst in 2000. It saw the trouble long before most people did.
Okay, so here's the main criticism you'll hear, and it's a fair point. The signals can be a little late to the party. Why? Because remember, it's a business forecaster. It's not trying to guess, it's waiting for proof. It's confirming a trend, not predicting it. But here's the thing, late is not the same as useless, far from it. That confirmation often comes early enough to let you ride the biggest part of a bull market, or, even more importantly, to get you out of the way before a bear market really destroys your portfolio.
All right, so Dow theory is fantastic. It's our high-level compass. It tells us the direction of the big, powerful economic currents. But you know, that's not enough. We also need to navigate the day-to-day choppiness. For that, we need a much more detailed map.
Think of it this way. Dow theory tells you whether the tide is coming in or if it's going out. But it's the charts that actually map out every single wave. They show you exactly where you are right now, and they give you some incredibly powerful clues about where the next wave might be taking you.
And that brings us to our second essential tool, stock charts. If Dow theory is our compass, then charts are our high-resolution maps. They are literally the language of the market, taking millions of trades and turning them into a picture. And that picture tells a story, if you know how to read it.
Now, not all charts tell the story in the same way. The classic line and bar chart, that's your all-purpose workhorse, great for seeing price and volume over time. Then you've got point and figure. This one's really interesting. It completely ignores time and only cares about major price reversals. It's an amazing tool for filtering out all the insignificant daily noise. And then you have candlesticks. These have become incredibly popular for one big reason. They give you an instant visual snapshot of the psychology of the market on any given day.
Let's just do a quick breakdown of a candlestick. It's genius in its simplicity. The fat part is the body. That's the distance between the open and the close. The color tells you who won the day.
A white or empty body means the price closed higher than it opened. The bulls were in charge. A black or filled body means the close was lower. The bears won that round. And those little thin lines, the wicks, they show you the highest and lowest prices reached during the day. In a split second, you get a feel for the battle that took place.
So, we have our compass and we have our maps, but now we're getting to the absolute soul of this whole thing. What are we actually seeing when we look at these lines and patterns on a chart? It's so much more than just numbers.
I love this quote because it's so true. A chart isn't a magic crystal ball. It's a mirror. It just reflects what is. Its value, its usefulness depends 100% on the person looking into it. The chart is never wrong. The challenge is always with the person trying to interpret it.
And here it is. This is the big secret, the key insight. Those patterns you see, the head and shoulders, the double tops, the flags, those are not stock patterns. They are people patterns. They are the graphic representation of mass human emotion. You are looking at a picture of greed, fear, hope, and panic, played out over and over again. You're not reading a stock, you're reading human nature.
And how do we know this is true? Because the same patterns that technicians identified 90 years ago are still showing up on our charts today. Why? Because the companies change, the technology changes, the world changes, but our basic human emotional responses to winning and losing money, they don't change. They're hardwired into us, and that is why charting still works.
So when you put it all together, what's the real benefit here? Well, charts help you figure out not just what to buy, but that all-important question of when to buy. Even more crucial, they give you a clear, logical reason for when to sell, taking your own dangerous emotions out of the equation. They protect your capital by giving you clear signals. At the end of the day, charts simply follow the money, and a good chartist learns to follow the charts.
So we'll leave you with this one final question to think about. If a chart really is a mirror of the market's collective fear and greed, it's also a mirror of your own. So when you look into it, what's it going to reflect back at you? Will it show discipline and a clear plan, or will it show your own fear and your own greed? The answer to that, well, that's everything.
You know, for what feels like forever, the name of the game in investing was growth, right? Just push capital out there, take some risks, aim for the moon. But the music's changed. And when the music changes, so does the dance. That euphoric bull market is now just a memory. And today, we're all facing a completely different kind of challenge. So today, we're going to explore this new landscape, and we're going to focus on the absolute #1 priority in a bear market: preserving your capital.
And this quote from 1931, right in the middle of the Great Depression, this is really where we need to start. It's such a powerful reminder that getting through these kinds of markets, it's not about how big your portfolio is. It's about how strong your mindset is. Success right now is a psychological game. It's a battle of temperament. It's all about how you think about your money, not just how much of it you have.
So here's our game plan. First, we're going to talk about the new mindset you've got to have to navigate these waters. Then, we'll get into how to figure out what stage of the market we're actually in. From there, we'll do a deep dive into the 5 critical choices you face during those tricky bear market rallies. After that, we'll look ahead, prepare for the eventual turn. And finally, we'll tackle what is, without a doubt, the most important piece of this whole puzzle: winning that battle inside your own head.
Okay, Section 1, a new market mindset. Look, after years where the only real strategy was just buy more, the game has fundamentally changed. We've had to shift from playing all-out offense to playing a disciplined, rock-solid defense. It is all about protecting what you have, first and foremost. That's the new prime directive.
This right here, this gets to the absolute heart of it. Preservation of capital means you completely flip your priorities on their head. Before you even allow yourself to think about potential profits, you have to obsess over potential losses. You have to ask, what's the absolute worst that can happen here? And that goes against every natural instinct we have, which is to dream about the best-case scenario. In this market, that instinct can be your worst enemy.
And that defensive mindset, well, it leads us right here to our next point. You have to know the market stage. Think about it like a sailor. You wouldn't use the same strategy in a calm sea that you would in a Category 5 hurricane, right? The right move, the smart move, depends entirely on your ability to correctly identify where we are in the market cycle, because a strategy that works in a late bull market can be absolutely suicidal in the middle of a bear market.
And here's that life cycle in action. In a late bull market, as the party's starting to wind down, you begin methodically selling using stop losses. The second that bear market is confirmed, the action needs to be decisive. Get out. Don't get cute, don't hesitate, just get out.
The middle stage, which is the longest and trickiest part, is all about navigating these violent up and down swings. And then finally, in the late stage, you pivot your thinking completely and you get ready to go back on offense again.
All right, now we're at the core of our strategy, the 5 choices you have during a rally. A bear market rally is one of the most psychologically treacherous, most dangerous times for an investor. The market is screaming upwards, the financial news suddenly gets all euphoric, and it feels like, phew, the bad times are over. But are they really?
This is the question, isn't it? It's the one that keeps you up at night. You see green on the screen for days, maybe even weeks. The so-called experts on TV are calling the bottom, and your own emotions are just screaming at you to jump back in with both feet. That fear of missing out, FOMO, it becomes this overwhelming force. Making the right decision right here, against that powerful emotional tide, is what separates the winners from the losers in a bear market.
So when you're faced with that rally, you really have 5 distinct strategic paths you can take. Each one is a different philosophy. You can sell methodically, right into that strength. You can choose to buy, but with extreme selectivity. You could go on the offensive and actually sell short. You can make the incredibly powerful decision to just sell and stay out completely. Or you can adopt the super disciplined approach of never ever fighting the major trend. Let's break each of these down.
Now, choice number 1 is the most logical, and it's also the most gut-wrenching. The top of a bear market rally is very, very likely the highest price you're going to see for your stocks for a long, long time. We're talking potentially years. But at that exact moment, the noise is going to be deafeningly bullish. The pundits will be calling for new highs. It creates this huge psychological barrier. Your job is to ignore the hype, trust your plan, and sell. It feels like you're leaving money on the table, it really does, but it's the disciplined move that saves your capital for the real recovery.
I absolutely love this quote from Robert Rhea. It just perfectly captures the challenge. You know, we can sit here and talk about strategy all day. We can lay out the perfect logic on these slides, but when it's time to actually pull the trigger, you're on your own. You have to face down your own personal demons of fear and greed and hope. It's your battle to fight, and it is never, ever easy.
Okay, on to choice 2, which kind of takes the view that the best defense is a good offense. You can participate in the rally, but you have to be incredibly selective. You're not just buying the market, you are hunting for that tiny fraction of stocks, maybe 10 to 25%, that are showing real technical strength. You're looking for charts with solid support, new uptrends, and increasing volume. Now, for those who want a less hands-on approach, a diversified mutual fund can be a more conservative way to play this.
And this is the non-negotiable rule for that strategy. You absolutely cannot go all in. A maximum commitment of 25, maybe 30% of your capital is the hard and fast rule. And why? Because you must always operate under the assumption that you could be wrong. This limit is your firewall. It's what protects the vast majority of your capital if the market suddenly decides to turn south again.
This slide really paints a stark picture when it comes to short selling. The amateur shorts out of panic, right? After a stock has already collapsed, when the risk is high and the reward is actually pretty low. The professional does the exact opposite. They short into strength, near the peak of a rally, when that bullish euphoria is at its absolute highest. This lets them set a razor-tight stop-loss just above the peak, which minimizes their risk while maximizing their potential profit on the inevitable next leg down.
Our 4th choice is maybe the most underrated, and it's captured perfectly by this quote. In a chaotic, stormy market, sometimes the smartest move is no move at all. It's about having the strength and the wisdom to just drop anchor and simply wait for the storm to pass. And make no mistake about it, this is not a passive choice. This is a strategic one. Deciding to sell out and stay on the sidelines takes immense courage, especially when you see the market just ripping higher day after day. It means admitting you don't need to play every single hand. You sell, you move your capital into something safe like treasury bonds, and you wait. You are actively preserving not just your capital, but maybe more importantly, your sanity. And finally, we have the most disciplined approach of all. This strategy basically says, the major trend is down, so I will only play on the downside. You hold short positions. As soon as a rally begins, you cover those shorts, lock in your profit, and then you sit on the sidelines in cash for the entire rally. You don't try to buy, you don't get tempted. Once that rally shows signs that it's failing, then you reestablish your short positions. This method protects you from getting whipsawed, caught in those violent back and forth swings of these tricky counter-trend moves.
So after weathering the storm, we eventually get to the final stage of the bear market. And here, your mindset has to shift again. It's no longer about pure defense, it's about methodically preparing to go on offense for that new bull cycle that is inevitably coming.
So at the bottom, you face two huge dilemmas: when to buy and what to buy. For the when, the choice is, do I start buying now while prices are beaten down and I can collect some dividends, or do I wait for absolute confirmation that a new uptrend has begun? Well, the answer really depends on your alternatives. If your cash isn't earning much, buying for yield can be a pretty smart move. Now, for what to buy, history gives us a surprising clue. It's usually not the big, safe blue-chip stocks that lead the charge out of a bear market. It's typically the low-priced, medium-quality stocks, the ones that got beaten down the most, that have the most explosive gains in the first phase of a recovery.
And that brings us to our final and by far most important section. Look, we can analyze charts all day, we can follow indicators, and build these brilliant strategies on paper, but none of it means a thing if we can't master ourselves. The real key to success, the secret ingredient, is winning the inner battle.
The market is really nothing more than a giant mirror of human psychology. It's just a big tug-of-war between fear and greed. And to win, you have to achieve intellectual domination over your own primal emotions. You have to be able to execute your plan with cold, rational discipline even when every fiber of your being is screaming at you to do the exact opposite.
This quote really captures the great paradox of investing. The most effective rules are incredibly simple, but achieving that simplicity is incredibly complicated. And why? Because we are just bombarded with an endless stream of noise. The news, the expert opinions, our own emotional highs and lows. Your job is to filter out all of those distractions and just stick to the simple, effective truths that actually work.
I mean, does any of this sound revolutionary? Of course not. It's basic common sense. Sell your losers, let your winners run. Cut your losses quickly. We all know these things intellectually, but our emotions hijack our brains and they make us do the exact opposite. We cling to our losing stocks, praying they'll come back, and then we sell our best winners way too early out of fear. The entire game of investing really comes down to just one thing: making this common sense your common practice.
And so we end here. The strategies for preserving your capital, they're not complex. They're logical. They're simple. But executing them requires a level of discipline and emotional control that most people just do not possess. So the real question you have to ask yourself isn't whether you understand the strategy, it's whether you have the temperament to follow it. The battle isn't with the market, it's with the person you see in the mirror. Are you prepared to win?
So let's talk about a side of the market that, let's be honest, a lot of people misunderstand or are even a little scared of. I'm talking about short selling. You know, the art of profiting when stocks actually go down. It's a seriously powerful tool, especially in bear markets. Today, we're going to break it all down: how it works, how to do it smartly, and maybe most importantly, why it's a vital part of a healthy market, even if it has a bad rap. I really wanted to start with this quote from Disraeli because, well, it just perfectly sums up the mindset of a short seller. It's all about questioning what everyone else takes for granted. See, the predominant opinion, the background noise of the market, is almost always bullish. Buy, buy, buy. But what this quote reminds us is that sometimes the most profitable move is to look at what the crowd isn't doing. And I want you to really let that question sink in. Picture a market downturn. The vast majority of investors are just glued to the screen, watching their portfolios bleed red, just hoping it'll stop. But what if? What if you had a strategy that could turn all that red into an opportunity? That's the whole idea behind short selling. It's not about rooting for a disaster, it's about being ready to play the game no matter which way the field is tilted. All right, so first up, let's get into the psychology of it all. Why is it that pretty much the entire financial world, from the big advisory firms to the average person, is so wired to only think about buying? It's just human nature to be optimistic, right? But in the markets, that kind of one-track mind can be a very expensive habit. And this really gets to the heart of it. The public just isn't wired to think about making money on the way down. But here's the reality. Bear markets are a fact of life. And when they hit, they are often way faster and way more vicious than the slow climb of a bull market. Now, what that means is, for the few who are prepared, the potential to make serious gains in a very short amount of time is absolutely real. It's about having the right tools in your toolkit for any weather, not just for the sunny days. Okay, so this is the part where a lot of people's brains start to hurt. Wait, how can you sell something you don't even own? It sounds like some kind of financial magic trick, but I promise you the mechanics are actually pretty straightforward. So let's pull back the curtain and demystify this whole process right now. That's really it right there. At its core, you're just borrowing something, in this case, shares of a stock, and you're promising to give them back later. Think of it like borrowing a cup of sugar from your neighbor. The key difference is, instead of using that sugar, you immediately sell it at the store. The whole bet is that by the time your neighbor wants their sugar back, the price will have gone down so you can buy it back cheaper and pocket the difference. Let's walk through this with some simple numbers. Let's say you think XYZ Corp is way overvalued at $55 a share. Step 1, your broker lends you 100 shares. Step 2, you turn around and immediately sell them. Boom, your account gets credited $5,500. Step 3, you wait. A few weeks go by and you were right, the stock tanks, dropping to $44. Step 4, you cover your short. You buy back those 100 shares for just $4,400. You give the shares back to your broker, and that $1,100 difference, that's your profit. You're still doing buy low, sell high. You just did the sell high part first. And this is a really important advantage to understand, especially if you're comparing this to options. When you buy put options, which is another way to bet against a stock, you're literally fighting a ticking clock. Every single day that goes by, that option is losing value. With a direct short sale, you don't have that pressure. As long as your account is in good shape, you could, in theory, hold that short position for months or even years, waiting for your analysis to prove correct. Okay, so we've got the mechanics down. Now let's talk strategy, because this is crucial. Shorting has this reputation for being incredibly risky. And you know what? It is, if you don't manage that risk. A stock you buy can only drop to zero, right? But a stock you short could theoretically go up forever. Now that sounds terrifying, but there is one simple rule that puts you in complete control of that risk. This is it. This is the single most important rule in this entire explainer. You have to protect your position by placing a stop-loss order, which for a short position is actually called a stop-buy order. You decide ahead of time what your maximum loss is going to be. If you short a stock at $50, you might put in an order to automatically buy it back if it climbs to $55. That way, if you're wrong, and you will be wrong sometimes, you get out with a small, manageable loss. No blown-up accounts, no sleepless nights. And the timing on this is everything. You have to put that stop order in the very same day you open the trade. Why? Because in that moment, you're thinking clearly. You're being objective. If you wait and the stock starts moving against you, your emotions kick in. You start hoping. You start rationalizing. You think, oh, it'll turn around. And that's how a small, disciplined loss turns into a catastrophic one. Set it and forget it. So let's just make sure this is absolutely crystal clear. When you own a stock the normal way, a long position, a stop loss protects you from it falling. Simple enough. For a short position, your risk is the stock rising, so you use a stop buy to protect yourself. They're perfect mirror images of each other, and they both do the exact same thing. They take your emotions out of the driver's seat and cap your losses before they get out of hand. Okay, so we know how it works. We know how to protect ourselves. Now for the fun part. How do we actually find good stocks to short? This isn't about just betting against companies you don't like. It's about a cold, calculated search for specific signs of weakness, characteristics that suggest a stock is vulnerable and ready for a fall. This is a fantastic checklist to start with. First, you're looking for stocks that have just had this huge emotional run-up. You know the type, all hype, no substance. Next, you look for what's called a top area of distribution. That's a fancy way of saying there's a ton of trading volume, but the price just isn't going any higher. That's a big red flag that insiders are selling. A crazy high PE ratio is another classic sign of overvaluation. And finally, you want to see a relatively low short interest. That tells you that you're not jumping into a trade that's already super crowded, which can be really dangerous. And we can get even more specific. Give preference to stocks that have a history of making big drops, or stocks in industries that are clearly struggling. Technical chart patterns, like a double top, can give you a great entry signal. Now, what's really interesting is that last point. You often want to short popular, widely traded stocks. It might seem safer to go after some tiny, obscure company, but the big blue chips are liquid. That means it's easy to get in and, more importantly, easy to get out. Look, we can't really have an honest conversation about short selling without talking about the elephant in the room. A lot of people feel like there's just something wrong with it, something unethical or immoral about betting on failure. So let's just tackle that idea head on. This is the accusation that's been thrown at short sellers for centuries, literally, that there's some kind of financial vultures rooting for companies to fail so they can profit from the wreckage. But is that what's really going on? Or are they actually playing a crucial, beneficial role in the market that most people just don't see?
This quote is incredible. It's from a conversation with Napoleon Bonaparte, of all people, who thought short selling was treasonous. His finance minister had to explain it to him. A short seller isn't wishing for a company to fail. They're doing their homework, they're running the numbers, and they're making a judgment that a stock is overvalued. It's an act of realism, not malice. And if you look at history, it tells a very clear story. Every time regulators have tried to ban short selling, it has backfired. Look at this timeline. England, France, New York, Germany, they all tried it, and every single one of them eventually had to repeal the ban. Why? Because they found out the hard way that a market without short sellers is actually more unstable and prone to even worse crashes. And this is the economic reason why. This is the key that so many critics just completely miss. Every single short seller is a future buyer. Remember step 4 of the process? To make money, you must buy the stock back. So think about what happens in a market panic. Everyone else is desperately trying to sell. Who's on the other side of that trade buying? The short sellers are. They provide a natural cushion of demand that helps to slow down a crash. And hey, you don't have to take my word for it. This is from the president of the New York Stock Exchange all the way back in 1914. He knew that a big group of short sellers wasn't a threat to the market. It was a safeguard. It was a guaranteed pool of buyers who would be there to step in and cushion a disastrous fall. And this chart shows you exactly what happens when that safeguard is missing. Right before the Great Crash of 1929, the amount of short interest in the market was tiny, almost non-existent. There was no cushion. So when the panic selling started, there were no built-in buyers to slow it down. It was like a car with no brakes. And that's one of the reasons that crash was so violent and so deep. So let's wrap up this moral argument with a very practical thought. What's more responsible, to blindly hold your investments through a downturn and lose your capital, maybe even becoming a burden on your family or society? Or is it more responsible to use every tool at your disposal to protect your capital and maybe even grow it, so you can remain financially independent and secure? When you think about it that way, the answer becomes pretty clear. And so, I'll leave you with this final question. Because a bear market isn't a matter of if, it's a matter of when. One is always coming, eventually. And when it does, most investors will just hunker down, play defense, and hope to survive. But you now know there's another way. You have the choice to not just protect yourself, but to actually go on offense. The only question is, will you? So what if I told you there's a way to actually make money in the market, even when you guess the direction wrong? Yeah, I know, it sounds a little crazy, but there's a method that completely flips conventional wisdom on its head. It swaps out that impossible game of fortune-telling for something you can actually control, your discipline and your tactics. You know, this old proverb really nails the whole idea. A nimble sixpence is better than a slow shilling. What that really means is that small, quick, and most importantly, secure gains are way more valuable than chasing some huge, slow, uncertain profit. In today's markets, that wisdom has never been more true. So we're going to forget about hitting home runs. We're going to focus on just consistently getting on base. I want you to really think about this for a second. The entire financial news world is built on one thing: predictions, forecasts. But what if all of that was just noise? What if your success had nothing to do with how good your guess was, but everything to do with how good your plan was for when that guess, inevitably, turns out to be wrong? That's the huge shift in thinking we're going to dig into right now. All right, so here's our roadmap. We're going to break this down into 5 simple parts. We'll start with the big idea, the core philosophy. Then we'll build out the actual mechanical formula for profit. After that, we'll get into picking the right stocks, mastering the all-important mental game, and then finally, we'll wrap it all up with a set of rules that could literally save you. Okay, let's dive into section 1, guessing wrong, winning anyway. This right here is the foundation for everything else. It's that fundamental shift we have to make, moving our focus away from predicting and toward mastering our execution. See, here's the thing you got to understand. All that research you do, all your knowledge, that helps you decide when to get into a trade. But none of it, not one bit, helps you decide when to get out. And let's be honest, profits are only real once you've cashed out, right? The money is made or lost based on the tactics you use to manage and exit that trade. And that's where pure, simple discipline will beat a brilliant prediction every single time. All right, section 2, the core profit formula. So we've covered the why, now let's get into the how. This is the engine of the whole strategy. It's simple, it's repeatable, and when you follow it with discipline, this little formula is designed to do one of two things: protect your money at worst, or make you a nice profit at best.
So here's the 4-step process. Super simple. First, you find a stock that's got a nice, clear trend. Second, you take your position. For our example, we're going to say you sell short, which is just a bet that the price is going to go down. Third, and this part is absolutely non-negotiable, you immediately place your insurance policy, your stop-loss order. But, and here's the real magic, step 4, you don't just set it and forget it, you actively manage it, moving it down as the price moves in your favor. And this is where the genius of the system really shines. Let's imagine you short a stock at $50 and you set your initial stop loss at $52. Now, if that stock drops to $45, you then move your stop down to, say, $47. The second you do that, you have locked in a guaranteed $3 profit. It doesn't matter what happens next. A sudden reversal, bad news, you cannot lose money on that trade. The profit is sealed. This one little tactic changes trading from a guessing game into a game of risk management. You know, we really need to change how we think about a stop loss. So many people see it as, well, as a sign of failure. They think, I got stopped out, I was wrong. That's just your ego talking. A pro sees a stop loss as an insurance policy. When it gets triggered, you haven't failed. Your insurance just paid out, protecting you from a disaster. You took a small planned hit so you can get back in the game tomorrow. Okay, on to section 3. Smarter stock selection. So we've got the core tactic down for managing the trade. Now let's get a little smarter on the front end of this thing. How do we find the absolute best candidates to apply this formula to in the first place? Well, here's a pretty solid checklist to start with. First, you want high volume. That just means you can get in and out easily without any drama. You need a confirmed trend, because that's what we're riding. It's a good idea to avoid those super cheap sub-$5 stocks, because they can be really erratic. And you always want to just glance at the chart, make sure there are no obvious signs that the trend is about to die. And hey, if you can find a stock where the whole industry is moving in the same direction, that's like having a strong wind at your back. Now, for a more advanced tool. To use it, we've got to understand this term, floating supply. Now, this is not the total number of shares a company has. Not at all. It's the number of shares that are actually available for people like you and me to trade. Knowing this is so important because it gives us the real picture of a stock's supply and demand, which, as you'll see, is critical for our next calculation. Okay, let's just walk through this example nice and slow for Zip Corp. They've got 1 million shares in total. But look, big institutions and company insiders are holding on to 3/4 of them. So the actual floating supply is only 250,000 shares. Now, we see that 60,000 of those shares are being held short. To get our ratio, we just divide the shares held short by that floating supply. So 60,000 divided by 250,000, that gives us 0.24, or a short interest ratio of 24%. So what on earth does that 24% number actually tell us? Well, a really high ratio like that means a massive chunk of the available stock is being bet against. And that creates a super dangerous situation for short sellers called a short squeeze, where any little piece of good news can make the price just explode higher. So a high ratio is actually a bullish sign, a stock you would definitely not want to short. On the flip side, a low ratio, like 7%, is a bearish sign. It suggests it's a much safer bet for a short position. And here's one last little layer of confirmation you can use. Just compare the stock's average weekly trading volume to the total number of shares being held short. If, say, 50,000 shares are traded in a week, but the total short interest is only 9,000, that's bearish. There just isn't a lot of buying pressure that could prop up the price. But if the short interest is bigger than the weekly volume, that's a very bullish sign because that short squeeze we talked about becomes a very real threat. All right, section 4, mastering your psychology. We've gone over the mechanics. We've covered how to pick a stock, but the original author of this system is crystal clear. None of it matters if you don't have the right mindset. This section is all about mastering the single most important part of this whole thing, your own brain. Now, this slide paints such a clear picture. The amateur is completely driven by their ego. They just have to be right. They'll ride a losing stock all the way into the ground, refusing to admit they made a mistake, just hoping and praying the market proves them right. The pro couldn't care less about being right. Their one and only goal is to make money, they admit mistakes in a heartbeat, they cut their losses short without a second thought, and they only care about that bottom line. This quote right here really gets to the heart of the problem.
It's a subconscious trap that so many of us fall into. Our pride is so powerful that it actually makes us sabotage ourselves. Think about it. We would literally rather lose money and protect our ego than admit a small mistake and protect our capital. To succeed with this system, or any system really, you have to make a conscious choice to put your profits ahead of your pride. So how do you actually do that? How do you take your ego out of the equation? Well, here is a piece of advice that is just beautifully simple and practical. Keep your mouth shut. Seriously. The moment you start telling your friends and family about your trades, you've just invited your ego to the party. Now you have something to prove. You don't want to look stupid. But just keeping your positions to yourself, you make it a million times easier to admit a mistake and get out of a trade logically, without all that emotional baggage. And that brings us to our final section, where we're going to pull everything we've talked about together into a clear, simple set of rules. You have to remember, in a market that's pure chaos, having a disciplined set of rules isn't a limitation, it's your salvation. Okay, so here they are, the golden rules. First, find a high-volume stock with a sharp, clear trend. Second, just focus on one stock at a time. It keeps things simple. Third, let the market take you out of the trade with your stop loss. Don't try to outguess it. Fourth, actively manage that stop loss to lock in those profits as you go. And finally, the most important one, forget pride of opinion. Just focus on what the market is actually doing, not what you think it should be doing. And look, if you need any more motivation to follow a set of rules, just let this sink in. This is a chilling statistic from back in 1927. A bookkeeper at a big brokerage firm who could see inside 5,000 different client accounts said he only knew of one account that was actually profitable. One. The odds are just brutally stacked against the undisciplined. Your tactics, your rules, they're the only thing that levels the playing field. And that really brings us to the final, most important question of all. We've laid out the entire method for you. It's simple, it's logical, it's been tested. Having the knowledge is no longer the problem. The only question left is the one you have to ask yourself. You have the method now, but do you have the discipline to actually follow it? Let's talk about investing. Are you still using the same old playbook, the one that says buy and hold and just wait? Look, if you are, you're probably leaving a lot of money on the table. The market today is a completely different animal. It's fast, it's volatile, and that old strategy can be a recipe for disaster. So today, we're going to arm you with a totally new set of rules, a new way of thinking, really, that will help you not just get by, but actually thrive. This is all about becoming a flexible investor. You've got to love this old saying from Wall Street, because it's just so true. It's a huge reminder that when everything's going up, we all feel like geniuses, right? I mean, think back to the dot-com bubble. Everyone was a financial wizard, right up until the moment they weren't. When the tide goes out, you really see who has a solid plan. And in today's world, where the market can turn on a dime, just blindly holding on is not a strategy. It's a gamble. We need a new playbook, one that's built for agility, not just blind optimism. So, how are we going to build this new playbook? Well, here's the roadmap for today. First, we'll get real about the market's new reality. Then, we'll talk about a big shift, adopting a trader's mindset. From there, we'll get practical and look at the tools you need in your flexible investor toolkit. After that, we dive into the deep end, mastering your own psychology. And finally, we'll pull it all together so you can start crafting your own personal strategy. Okay, first things first, let's really dig into why those old investment maps are just useless now. The landscape we're operating in today is fundamentally different than it was even 10, 15 years ago. The terrain has completely shifted, and if you're using an old map, you're going to get lost. Wow, I mean, just look at this comparison. It really lays it all out, doesn't it? It feels like we went from a slow, predictable cruise down the highway to a chaotic, high-speed race through city streets. Buy and hold has been replaced by active monitoring. What was once slow and stable is now jittery and volatile. And we've gone from simple stocks to this whole universe of complex derivatives. The message couldn't be clearer. That passive, set it and forget it approach just doesn't cut it anymore. You need to be active, you need to be flexible. And this is the real hard truth about clinging to that old buy and hold idea. It's not just that it might not work as well, it can be a genuine portfolio killer. You're basically chaining your money to a stock that's going down, just hoping that one day it'll magically float back up. That recovery could take years, if it ever comes at all. And in the meantime, your capital is just dead in the water, missing out on countless other opportunities that are sailing right by. So that brings us to the solution. And it's not some magic indicator or a secret algorithm. It's a fundamental change in how we think about investing. It's about adopting what we call a trader's mindset. Now, I know what some of you are thinking. The word trader can sound a little scary, a little risky. But let's get something straight. This is not about becoming a day trader, glued to your screen, hopped up on caffeine. It's about a philosophical shift. It means being nimble, being alert, and, this is the big one, being willing to get out of a position quickly when it's not working. Your number one job becomes protecting your capital. This right here, this is the most powerful question you can ask yourself as an investor. Seriously, it's your new secret weapon. For every single stock you own, you need to ask yourself this constantly. It forces you to reevaluate every holding based on what you know today, not what you hoped for yesterday. And if the honest answer is no, then you have to ask the follow-up. Then why in the world do I still own it? It's a game changer. Okay, so how do you develop this mindset? It's not always easy, and that brings us right to our very first rule. And this is the great news, really. This way of thinking isn't natural for most people. Our instincts tell us to hold on, to hope, to avoid admitting we made a mistake. But you have to remember, this is a learned skill. It's just like learning to play an instrument or a sport. It's going to take practice. It's going to take discipline. And yeah, you're going to make some mistakes along the way. So don't get frustrated if it feels a little weird at first. You can learn this. You will get better at it.
All right, so you've got the mindset down. Now what? Well, you need the right tools to put that mindset into action. This is where the philosophy gets practical.
First up, and this is absolutely critical, is the chart. According to rule number 5, if you're investing without looking at a chart, you are flying blind, period. Charts are how you see what the market is actually doing. They help you spot trends, find good places to get in or get out, and they even help you understand a stock's unique personality. And I love this piece of advice. When you're starting out, actually draw the charts by hand. It sounds old school, but it forces you to internalize the patterns and develop a real intuitive feel for the market. Next in the toolkit is a really powerful defensive move called hedging. Now, this can sound super complicated, but Rule 4 breaks it down nicely. Just think of it like buying insurance for your trade. So you buy a stock you really believe in for the long term, but suddenly it starts to drop. Instead of panicking, you can actually short the stock, which is a way to bet on it going down. You can profit from the decline. Then, once it finds a bottom, you close out that short for a profit, and you still own your original shares, ready for the rebound. You've protected yourself. And here it is, the million-dollar question every single investor struggles with. When do I sell? Rule number 8 gives us a simple, disciplined, and incredibly effective answer. If you buy a stock and it immediately starts falling, just sell it. Get out. Don't even think about it. If it goes up, you've got 2 options. Sell when it hits a price target you set beforehand, or sell as soon as it starts to fall and threatens the profit you've made. And this is the golden rule, the one you should write on a sticky note and put on your monitor. Never let a good profit turn into a loss. Okay, we've covered the market, the mindset, the tools. Now we need to talk about what is, without a doubt, the hardest part of this whole thing. You can have the best system in the world, but if you can't control what's going on between your ears, none of it matters. It's time to win the inner game. And that brings us to a rule that is just, it's foundational to your growth as an investor. Rule number 9. This is all about taking complete ownership. It is so easy to point fingers when a trade goes bad, right? Oh, the market was crazy. My advisor gave me bad advice. But that's a dead end. It keeps you from learning. When you force yourself to take 100% responsibility, you have to look at your own decisions. Did I chase a hot stock? Did I ignore my own rules? Only by blaming yourself can you actually find the lesson in the loss and make sure it doesn't happen again. And taking ownership leads us directly to the next huge psychological barrier we all have to face, and that's covered in rule number 10. Let's talk about ego. It is, without a doubt, the single most destructive force in investing. We've all been there. You nail a few trades in a row, you start feeling invincible, like you can't lose. And that pride, it's poison. It makes it almost impossible to admit you are wrong about a stock and just sell it. So how do you keep your ego in check? Here's a fantastic practical tip. Keep a loss log. Actually write down every single losing trade, how much it cost you, and your analysis of what went wrong. It's a very humbling, very necessary reminder that the market is always bigger and smarter than you are. All right, we've gone through the new reality, the trader's mindset, the essential tools, and the mental game. For our last section, we're going to put all these pieces together to build a strategy that is uniquely, personally yours. And this is rule number 6, and it's so important. There is no one-size-fits-all magic system here. We're all wired differently. Some people get a thrill from taking big risks. Others can't sleep at night if their portfolio drops by a single percent. Your strategy has to match your personality. It has to fit your own tolerance for risk and your own anxiety levels. Because a brilliant strategy that has you constantly stressed out isn't brilliant at all. It's just a recipe for burnout and bad decisions. And this idea of personalization leads us to the final and maybe the most empowering rule of them all. And there you have it. This is the ultimate goal. The rules we've talked about today, they aren't meant to be a rigid dogma. They're a foundation. They're a starting point for you to build from. Your job now is to take these ideas, test them out, tweak them, and forge your own personal rulebook. A strategy that you understand, that you believe in, and that lets you invest with confidence. Because at the end of the day, you are the CEO of your money. So, I'm going to leave you with a challenge. Don't try to implement all of this overnight. Just think about everything we covered. The charts, the importance of selling, the danger of ego. Which one of those ideas really resonated with you? What is the one single rule you can write down right now and commit to? Start there. Take that first step. That's how you begin the journey to becoming a more flexible, more disciplined, and hopefully a much more profitable investor.
Let's be honest for a second. There's nothing quite like the anxiety of a bear market, is there? It's that sinking feeling in your stomach, the one that can have any of us, new investor or old pro, staring at the ceiling at 3 in the morning. So today, we're going to tackle that feeling head on. We're going to break down a framework for defensive investing, one that's designed to help you navigate the storm and just maybe get a good night's sleep.
To get us started, let's throw it back to this classic bit of advice from Andrew Mellon. Now, I know, gentlemen prefer bonds sounds a little old-fashioned, but it points to a timeless truth, you know? When things get uncertain, the appeal of safety, of stability, which bonds have historically represented, it just comes roaring back. It's a great principle to set the stage for our whole conversation. But here's the thing. This isn't just about your stock portfolio. A real bear market is usually the canary in the coal mine. It's signaling much deeper trouble for the entire economy. And that means every single asset you own. We're talking your house, the cash in your savings account, even your own business if you have one. Everything needs a fresh set of eyes on it. It's time to reevaluate everything for safety.
So here's how we're going to break it all down in this explainer. First up is a reality check about what a bear market really means. Then we'll get into the most critical decision you have to make, which splits into 2 very different playbooks, one for an inflationary storm and one for a deflationary one. We'll also take a hard look at gold, and then we'll finish with what is, without a doubt, the most important factor of all, the one that's sitting right between your ears.
Okay, let's really dive in. The very first thing you have to get your head around is that a bear market is not some isolated event happening over on Wall Street. It's a signal. It's an indicator that the bigger economy might be headed for a recession or maybe even something worse. And that's exactly why we have to start thinking way beyond just our stocks. And that brings us to this idea of your defensive portfolio. So what is that? Well, it's basically everything else. Everything that isn't your stocks. Think bonds, cash, maybe some other stable assets. In times like these, the big questions you have to ask yourself are, is this part of my portfolio really as safe as I think it is? And should I be making it bigger?
You know, the legendary investor Sir John Templeton had a really great way of thinking about this. He said you should mentally just split your portfolio right down the middle. Half of it is for your long-term buy and hold stocks, but the other half, that's your flexible money, ready to move into defensive positions when you need it to. And he had this fantastic rule of thumb. Your stock holdings should never, ever be more than 3 times what you could truly afford to lose without it wrecking your life. That's a really powerful way to check yourself.
So before you even think about selling a single share or buying a bond, you've got to do something much, much more important. You have to take a step back. You have to look at all the economic data, the political landscape, everything you can get your hands on, and you have to form an opinion. You have to, as they say, take a view on what is actually happening out there.
And this all boils down to the one central question that's going to drive your entire strategy from here on out. What kind of recession are we actually heading into? Is it going to be short and sharp, or are we looking at something long, drawn out, and a lot more dangerous? I'm telling you, your answer to this question changes absolutely everything.
This slide does a great job of laying out the 2 main forks in the road an economy can take during a downturn.
On one side, you have an inflationary recession. Think of the 1970s. This is that slow, painful grind where the value of your dollar is just getting eaten alive by rising prices. On the other side, you've got a deflationary recession. Think the Great Depression in the 1930s. That's more like a sudden collapse, where prices are actually falling, nobody's spending anything, and cash becomes the only thing that matters. These are two completely different problems, and they require two completely different solutions.
All right, let's dig into that first scenario, the inflationary recession. In this world, your main enemy isn't that your assets are losing value, it's that your currency is. The name of the game is simply preserving the purchasing power of your wealth.
So, what works? Well, the source material we're looking at is crystal clear when it comes to real estate. In an environment where the dollar, or whatever your currency is getting weaker, tangible things, like a piece of property, hold their value. The advice is about as direct as it gets. Don't sell. Real estate becomes a cornerstone of your defense.
And that same logic applies to other things too. If you own a business, for example, your physical plant and equipment, those are real, tangible assets that actually go up in value. The same goes for collectibles, art, stamps, rare coins. They tend to do well. And here's a pretty clever move right out of the 1970s playbook. If your home currency is the problem, maybe you move some of your money into the bonds of a country with a much more stable currency.
Okay, now let's completely flip the script. What if your view is that we're headed for a deflationary bust? This is a totally different ballgame. Now, it's not about beating inflation. It's about one thing and one thing only: pure, unadulterated capital preservation. Why? Because in a deflationary world, cash becomes more valuable every single day. And just look at how the advice on real estate does a complete 180. In a deflationary world, rents are falling, there are no buyers. That tangible asset you owned suddenly becomes a massive liability, a money pit. The source suggests that if you see this coming down the pike, you're better off selling your investment properties before the whole market just freezes solid.
And that same harsh reality hits businesses too. When consumer spending just dries up, a lot of small businesses simply won't make it. And the bigger companies? They're forced into these brutal rounds of cost-cutting and mergers just to keep the lights on. It becomes an environment that's all about survival, not about growth.
This slide really captures the terrifying, sneaky danger of a deflationary spiral. I mean, look at this. In late 1930, a full year after the big crash, the consensus was still that the banks were solid. But just 1 year later, things had gotten so bad that the media was reporting only 18 bank failures a week as if it were some kind of good news. It's just a chilling reminder of how quickly a crisis can boil over when you're not paying attention.
So we've got these two very, very different potential futures. But the question is there any asset out there that might actually have a role to play in both scenarios? Well, according to our source, there is one asset that plays a pretty unique role whether the big bad wolf is inflation or deflation, and that asset is gold.
To really get a feel for gold's power during inflation, you just have to look at this one number: $850. Throughout the entire inflationary decade of the 1970s, gold went on a run that was just unbelievable. It went from $35 an ounce all the way to a peak of $850. It was the absolute best way to protect your wealth against a dollar that was just melting away. But, and this is a big but, the source is really clear that gold is not a simple buy-it-and-forget-it investment. It acts more like a pressure cooker. So the strategy they recommend is to keep a core survival stash, but then to actively trade around that position, buying on the big dips and selling into the massive run-ups. You see, governments often try to keep the price down, so its moves can be sudden and explosive when they finally fail.
So how much should you have? The specific recommendation is a 10 to 15% allocation in your portfolio. And it's important to note it's not just one kind of gold. The suggestion is to spread that allocation across physical gold bars, bullion coins, and the shares of gold mining companies. That way, you get a more balanced exposure to the metal.
All right, we've covered a lot of ground: bonds, real estate, businesses, gold. But for this last part, we need to talk about the single most important asset in your entire portfolio. And that asset is you. It's your judgment, your discipline, and your mindset.
And this is such a critical point. After you've done all your analysis, you might decide the best move is to sit tight and do nothing. But you have to understand that doing nothing is not a passive act. Choosing to stay put is an active investment decision, and it has to be based on the same tough, rigorous analysis as the decision to sell everything you own.
You know, the biggest trap for any investor isn't financial, it's emotional. It's not about being wrong. Hey, everybody's wrong sometimes. That's part of the game.
The real danger, the thing that can absolutely destroy you, is refusing to accept a new reality just because it's painful. It's when you start cherry-picking data, looking for any little piece of information that confirms your hope for a quick recovery, while you actively ignore a mountain of evidence telling you that things have fundamentally changed.
And that really leaves us with this final thought. It is never too late to sell, it's never too late to buy, it's never too late to reposition your assets based on your best judgment. The only question that truly matters is this one. Have you actually done the hard work to decide what the right thing is for you right now?
You know, when we talk about investing, our minds usually jump to the external stuff, right? Finding the next big company, trying to time the market, making sense of all the economic data. But what if I told you the single biggest obstacle to your success isn't out there, but it's right between your own two ears? Today, we're taking a hard look at the investor's biggest enemy.
And this quote from James L. Frazier just nails it. It really sets the stage for everything we're going to talk about. In a world that is just defined by uncertainty, the one thing you can actually get a handle on is yourself. And believe me, self-knowledge isn't just some philosophical idea. When it comes to investing, it is the absolute bedrock for making smart decisions, especially when everyone else around you is losing their minds.
All right, so here's our game plan. First, we're going to pinpoint who this inner enemy really is. Then, we'll look at how our emotions can totally hijack our decisions and explore that powerful, almost magnetic pull of the crowd. After we've diagnosed the problem, we're going to get into the solution. How knowledge becomes your shield, how you can actually start thinking against the grain, and what it really means to know yourself as an investor.
Okay, let's get right to the heart of it. You can spend years, I mean decades, soaking up everything there is to know about the market, reading reports, studying charts, you name it. But all of that hard work, all that expertise, it can be wiped out in an instant by one incredibly powerful force, your own emotions. Let's dig into why your feelings are so often your biggest liability. And this is the absolute crux of the matter. Just think about it for a second. Your rational brain, the one that's done all the homework, knows that a market dip is a buying opportunity. But your emotional brain, it's screaming, get out, sell everything now. And that battle, right there, between what you know and what you feel, that's where most investors get wiped out. It's not a knowledge gap, it's an emotion gap.
So let's see how this actually plays out in the real world. You know, the market never moves in a nice, neat, straight line. It moves in cycles, in waves, and each part of that cycle triggers a very specific and honestly a very predictable set of emotions that can absolutely take over your decision-making.
Now this slide, this is what I call the emotional roller coaster, mapped out perfectly. During a bull market, when everything is going up, what do we feel? Optimism, hope, and, yeah, let's be honest, greed. And that feeling pushes us to buy, a lot of times right at the top. Then you flip it. In a bear market, fear, pessimism, and just total despair take hold. And what does that make us do? Sell, usually right at the bottom. We instinctively do the exact opposite of what makes sense.
And here's a really critical point. These emotions aren't created equal. Fear is a much more powerful, much faster motivator than greed is. See, a bull market can kind of build slowly, on a foundation of optimism. But a bear market? A crash happens fast, and it's fueled by pure, raw, primal fear. It's why losing $1,000 feels so much worse than gaining $1,000 feels good.
So why? Why do we all seem to ride this same emotional wave at the same time? Well, the answer goes way back, deep into our DNA. As human beings, we are wired with this powerful primal need to be part of the group. And in the market, that translates directly into herd behavior.
You know, this isn't some new idea. Over 100 years ago, a sociologist named Gustav Le Bon figured this out. He saw that crowds don't run on logic or facts. They run on emotion and really attractive stories. The crowd doesn't want the complicated truth. It wants a simple narrative that feels good, whether that's a story of get rich quick or the sky is falling.
And let's be clear, this isn't about pointing fingers and saying, look at those foolish people. This is about us. It's about me. It's about you. That deep-seated need to belong makes it feel safe. It feels right to do what everyone else is doing. When the crowd is giddy, it feels dangerous to be cautious. And when the crowd is panicking, it feels absolutely insane to stay calm. Our gut instinct is to follow that herd, even if it's heading right for a cliff.
Okay, so we've laid out the problem. Let's pivot and talk about the solution. If our own emotions and our herd instincts are the enemy, what's our defense? How do we build up the mental armor to stand apart from the crowd? Well, the answer, at its very core, is knowledge.
But it's not just about piling up facts. It's about a specific kind of knowledge that acts like a shield against that fear and greed.
To beat an enemy, you have to understand it first. And fear, well, fear thrives in the dark. Its real power comes from ambiguity, from not knowing, from uncertainty. We imagine the absolute worst-case scenario simply because we don't have enough information to see things clearly. It's simple. We fear what we don't know.
And that leads us directly to the antidote. The only way to fight ambiguity is with information. The cure for fear is knowledge. When you study market history, when you truly understand that crashes and bear markets are a normal, expected part of the cycle, when you know what to do in those situations, you shrink the unknown. You're shining a flashlight into that dark room, and suddenly, the monster in the corner isn't so scary anymore.
This quote, this just perfectly illustrates the kind of courage that's born from knowledge. This famous piece of advice from Baron Rothschild, it's not about being reckless or crazy, it's about being so well-informed that you see a massive opportunity where everybody else sees only terror. It's the ultimate example of using knowledge to think differently, which is exactly where we're headed next.
So, we've established that knowledge is our shield. That's great. But how do you actually wield that shield when the arrows of fear and greed start flying? Let's get practical and talk about some specific mental tools you can use to put that knowledge to work and actually think for yourself.
Here is a simple, but man, is it a powerful process. Think of it as a cooled-off method for thinking. Step 1. The minute you hear some popular market opinion, your default reaction, your first instinct must be to reject it. Now, this isn't about being negative, it's about being a circuit breaker for your herd instinct. It buys you time to think. Step 2. Now that you've created some mental space, you study the situation objectively. You look at the real data, the fundamentals, the history, not the screaming headlines. And step 3, only after you've done your own homework do you decide if the crowd's opinion has any merit. And you'll find that most of the time, it really doesn't.
And within that process, there are two powerful voices you can learn to use. The first is true intuition. Now, I'm not talking about a random guess. I'm talking about an earned gut feeling that only comes from tons of research and experience. It's your subconscious mind spotting patterns that you might not even consciously see. The second tool, and maybe the more practical one, is to actively play devil's advocate with yourself. Have a real conversation. If your gut screams buy, force yourself to list 3 solid reasons to sell. Vigorously challenge your own first reaction. This kind of disciplined self-argument is one of the best ways to separate your emotions from your analysis.
So we've talked about emotions being the enemy and knowledge being the shield. But what's the actual goal here? Are we trying to become some kind of emotionless, hyper-rational investing robot? Let's tackle that, because the real answer might not be what you think.
Let's just ask the question head-on, because I think it's what a lot of us assume. Is the objective here to totally wipe emotion out of the equation? To reach some kind of perfect Zen-like state where fear and greed can't touch us?
And the answer is a hard no. Trying to achieve complete emotional control is not only probably impossible, it's the wrong goal anyway. The real objective for a successful investor is self-awareness. It's about acknowledging your feelings, understanding how they might be trying to pull you one way or the other, and then consciously factoring them into your decision, treating them like one more piece of data instead of letting them be the one running the whole show.
So to bring this all home, here are 4 final practical tips. First, really know yourself. What are your limits? What's your actual tolerance for risk? Not what you say it is. Be brutally honest. Second, become a relentless reader, especially of financial history. History gives you the context that kills fear. Third, surround yourself with successful investors who are humble and talk about their process, not just the ones bragging on TV. And finally, make contrary thinking a daily habit, not just a one-off trick. Question everything.
And I want to leave you with this final thought from the fathers of value investing themselves, Benjamin Graham and David Dodd. They knew that the market will never be a purely rational place. It is, and it always will be, a reflection of us, a messy, often chaotic, but fascinating mix of logic and emotion. The secret isn't to pretend the emotion doesn't exist, it's to understand it, both out there in the market and, most importantly, inside yourself.
All right, let's dive right in. Today, we're going to talk about a mental model that honestly feels more critical right now than ever before. It's called the art of contrary opinion. You know, in a world that's just flooded with information, where consensus seems to drive everything, learning how to think against the crowd isn't just some clever little trick. It's become a survival skill. It's how you navigate all the noise. So let's get into it.
And to really get this, we've got to go way, way back, over 2,000 years ago, actually, to the Greek playwright Euripides. This quote is just so powerful because, well, it's timeless. It absolutely nails the raw, and let's face it, often irrational nature of group emotion. Think about it. Whether it's a stock market panic or some new outrage on social media, the basic human behavior hasn't changed a bit. The crowd doesn't usually act with logic. It acts with this unchecked, almost childish emotion.
And that brings us right back to today, because that ancient idea, it's never been more true. With mass media and the social media algorithms creating these echo chambers we all live in, the range of opinions we even get to see is shrinking. It creates this atmosphere of sameness, this mass mind, where one story, one narrative can just take over everything. And that is exactly why the ability to step back and think for yourself has become so incredibly important. Now, you'd probably think that the biggest danger to society is, huge disagreements and conflict, but the whole theory of contrary opinion points to a totally different threat. The real warning sign, the big red flag, isn't when people disagree, it's when everybody agrees. So this is the key. Unanimity, total agreement should make you suspicious, especially at major turning points. When an idea gets so popular that it feels like nobody is even questioning it anymore, doesn't matter if it's in the stock market or in culture, that is the exact moment a contrarian thinker really starts to lean in and pay attention. It's a huge signal that critical thinking might have just packed its bags and left, and the old herd instinct is completely taken over.
Okay, so we see the problem, but what does it really mean to be a contrarian? Because this word gets thrown around and misunderstood all the time. It is not about being argumentative. It's not about being that guy who disagrees with everything just for sport. No, it's way more strategic, way more thoughtful than that. I love this definition from John Schultz because it's so precise. Look at the key phrases here: solidify into a dogma and lose their original validity. See, a contrarian isn't just standing on a soapbox shouting, "The crowd is wrong." They're more like a detective. They're making a very specific diagnosis, saying, hey, this idea, it might have been true once, but now it's just a stale, unquestioned belief. It's a dogma.
And this just hits the nail on the head. Look, simple contradiction is easy. Anybody can just say no to everything they hear. That's not thinking, that's just a reflex. Real contrarian thinking, that's about analysis. It's about looking at some super popular idea and asking a simple question. Are the reasons this got popular in the first place still true today? It's targeted, it's surgical. So here's the engine that makes this whole thing work. Life, the markets, our culture, they're all dynamic. They're constantly changing, right? But public opinion? It tends to move slowly, and then it gets stuck. It becomes static. Think about an investment strategy that was brilliant when only a few people knew about it. Well, by the time everyone on your street is talking about it and piling in, it's probably become incredibly risky. By the time an idea is on the cover of every magazine, the world has often already moved on. All right, let's take this theory and apply it where it gets tested with real stakes, the financial markets. This is the arena where thinking against the crowd isn't just a philosophical exercise. There's real money on the line. This is such a great way to visualize how opinion flows like money. Look at this cycle. Step 1. It always starts with a small group of sharp, savvy investors. They spot an opportunity nobody else sees, and they get in first. Then, step 2, the trend starts to become a little more visible, and a few more people notice. But step 3, that's the big one. That's when the majority finally catches on, feels safe, and everybody jumps in. This is peak consensus. The bandwagon is officially overcrowded. And that is the signal for the savvy investors from step 1 to quietly head for the exit and take their profits. And this just reframes the whole thing perfectly. See, the goal isn't just to be different. The goal is to be early. And in a world that's driven by trends and momentum, thinking before the crowd almost always means you have to think against where the crowd is right now. It's that old Wayne Gretzky line, right? You skate to where the puck is going, not where it's been. Okay, I know what you might be thinking. This is a fair question. Hey, this all sounds great, but in a world with the internet where news travels at the speed of light, hasn't this cycle been broken? Is the crowd just too fast now? Well, the answer is a hard no. In fact, it's the exact opposite. Modern media has put this whole cycle on steroids. Just think back to the tech bubble in the late 90s. You had news channels on 24/7 telling everyone that the old rules didn't apply anymore, that this time was different. It fueled this massive wave of euphoria. See, instant communication doesn't create more rational markets. It just accelerates motion. It makes the peaks of greed higher and the valleys of fear deeper. So let's zoom out from the markets for a minute, because this is so much bigger than just an investment strategy. This is a fundamental lesson that history has tried to teach us over and over and over again.
Man, the journalist Walter Lippmann just nailed it with this one. Widespread agreement is so often just a sign of intellectual laziness. It's a symptom. When an idea becomes so accepted that nobody even bothers to debate it anymore, it usually means that individual minds have just switched off. And that is exactly when we as a society tend to make our biggest mistakes.
I mean, history is just littered with these moments. In the late 1920s, the consensus was that we'd reached a permanent plateau of prosperity. Right before the Great Depression, during the Cold War, there was a constant popular fear of an imminent nuclear attack that was going to end everything. And who could forget the Y2K bug? The consensus was total chaos, planes falling out of the sky. In every single one of these cases, the overwhelming majority opinion was just dead wrong.
And here's the core lesson from all of that. It's simple. Complacency is the real enemy. The source material brings up the period just before September 11th. The consensus view then was that a massive attack on U.S. soil just wasn't a major risk. Our guard was down. And that's the point. The moment we believe we have it all figured out, the moment we feel invulnerable, that is precisely when we are the most exposed.
This quote from historian Paul Johnson just ties a perfect bow on it. History humbles us. It shows us that all our supposedly new and brilliant ideas have often been tried before, and sometimes they failed spectacularly. It's a constant, powerful reminder to be skeptical of our own certainty, and especially of the crowd's certainty.
Okay, so we've covered the why, the what, and the where. Now we get to the most important part, the how. How do we actually start to cultivate this way of thinking in our own lives, day in and day out?
First, let's be really clear about what we're up against. We are swimming in an ocean of information that is designed to make us all feel the same way. The news headlines, the trending topics, it all pushes us towards a comfortable, shared opinion. It encourages what the source calls robot thinking, where we just passively absorb ideas without ever stopping to ask where they came from or if they're even true. So how do we fight back? Well, here's a practical 4-part mental toolkit. First, you start with a foundation of healthy doubt. Just question things. Second, you always question the motive. Ask yourself, who benefits if I believe this story? Third, you become a detective for the truth, knowing that a half-truth is often just a very well-disguised lie. And finally, my favorite one, you train yourself to have an automatic reflex. When you hear some overwhelmingly popular opinion, just let a little voice in your head say, oh, yeah? That's the switch. That's what kicks your brain into gear. And I'm not going to lie to you, this isn't easy. The path of least resistance is to just go along with the crowd. Truly thinking for yourself, questioning your own assumptions, seeking out different views, being willing to admit you're wrong, that is some of the hardest mental work a person can do. But the payoff? It's huge. And it's not just about making better investments. It's about reclaiming your own intellectual independence. It is a fundamental part of being free. And so that's the final thought I want to leave you with. This isn't just some interesting theory. It's really a personal challenge. We live in a world that is constantly pushing you to conform, to agree, to just follow the herd. In that world, the simple act of thinking clearly and for yourself is a quiet act of rebellion. So the only question left is, are you willing to do the work? You know, if you've been around the markets long enough, you hear that old saying, history doesn't repeat itself, but it sure does rhyme. Today, we're not trying to find some magic crystal ball. Nope, we're looking for a map. We're going to dig into how the booms and busts of the 20th century can give us a framework, a real lens to understand the market's challenges, not just then, but now. Let's get into it. I wanted to kick things off with this quote from way, way back, because it just nails what we're trying to do here. This isn't about making some rigid, this is what's going to happen prediction. The market's way too wild for that. Instead, it's about building a flexible way of thinking, right? A model that helps us get ready for a bunch of different possibilities, so we're not frozen by fear or blinded by overconfidence. It's about being prepared, not prophetic. All right, so here's our game plan. First, we're going to set the stage, jump right into the year 2002, right after the dot-com bubble went bust. Then we'll take a trip back to the Roaring '20s, and you'll be amazed at the similarities. After that, we'll look at a totally different kind of boom, the one after World War II, to see what was different. We'll break down why history is more of a remix than a rerun, and then pull it all together to see what kind of new playbook an investor really needed. Okay, I want you to go back in time with me. It's early 2002. The smoke is clearing from the dot-com crash. All that insane euphoria from the '90s, gone, replaced by this deep, kind of scary uncertainty. And the question on every single investor's mind, it was a simple one, but man, was it a big one. What in the world happens now? Was this just a little hiccup, or was this the beginning of something way, way worse? So the general consensus, right, what you were hearing everywhere on TV, in the papers, was basically, hey, don't worry about it. This is just a little correction. The common thinking was that the massive bull market of the '90s just needed to catch its breath, and it would come roaring right back. People were just desperate to believe the party wasn't really over. But there was this other view, a much more cautious one. And it argued you couldn't just pretend nothing happened. First off, the dot-com bubble wasn't just a little froth. Its collapse did real structural damage. Second, the things that kicked off that huge bull market back in '82, like inflation and interest rates falling off a cliff, well, those conditions were gone. And third, this new war on terrorism, this was a whole different animal than the quick Gulf War. It created this long, dark cloud of uncertainty you just couldn't ignore. Now, to really get a grip on this alternate view, we've got to look back, way back. Turns out, the 1990s weren't so unique after all. If you really want to understand the vibe, the mechanics, and frankly, the madness of that decade, the best parallel you can find is 80 years earlier, the Roaring '20s. And the echoes are just fascinating. I mean, psychologically, these two eras were practically twins. In the 1920s, after the war to end all wars, people felt like, we did it. Progress is inevitable. Nothing can stop us now. Now, fast forward to the 1990s, the Berlin Wall falls, the Cold War ends, and boom, that same feeling of total victory and invincibility just sweeps over the country. Both decades were born out of these huge global wins, and that created this powerful wave of optimism that made people want to take big risks. And that optimism, it got supercharged by incredible, world-changing technology. For the '20s, you had electricity, the automobile, the radio. I mean, things that completely rewired daily life. For the '90s, well, it was the internet, of course. And just like back then, the internet wasn't just a tool. Oh no, it became this almost religious thing, a symbol of a new economy that was going to bring about this amazing new age of freedom and prosperity for everyone. And you know what happens when you get that much euphoria, right? You get excess. The 1920s had their shady new era bucket shops, literally selling stock in companies that didn't even exist. The 1990s had its new economy.coms, companies with no products, no profits, sometimes not even a real plan, yet they were getting valued in the billions. In both cases, the story, the dream, that became way more important than boring old numbers on a balance sheet. And this quote just nails the core connection. It wasn't just about greed. It was this deeper, almost spiritual belief that technology had finally cracked the code, that we could break free from the old rules of economics. It was this powerful, intoxicating idea that this time it's different. And boy, isn't that the most dangerous phrase in investing. It's the timeless fuel for every single bubble. Okay, so the 1920s and the 1990s feel eerily similar, but a good historical analysis isn't just about finding the perfect match. It's also about understanding the key differences. And to do that, we need to look at another post-war boom, but one with a totally different flavor, the 1950s and 60s. This is the crucial question right here. We've seen how that feeling of invincibility and we deserve this fueled the speculation in the 20s and the 90s. But what happens when a boom is built on a totally different psychological foundation? What changes when the mood of the country isn't euphoric, but is instead grounded? I mean, the difference here is night and day. The generation that came home from World War II had lived through the Great Depression and then fought a brittle global war. They were optimistic, for sure, but it was a sober, earned optimism. They knew things had to be built. Contrast that with the 90s. The Cold War was won without that kind of shared national sacrifice. And that led to a very different mood, not one of rebuilding, but one of entitlement, a feeling that prosperity was our birthright, and that, right there, is what fueled a much more dangerous, irrational kind of market mania.
Okay, so if the 1990s boom was like the 20s, you're probably thinking, well, does that mean the 2000s bust had to be a rerun of the Great Depression or maybe the miserable stagflation of the 1970s? Well, this is exactly where those simple one-to-one comparisons just fall flat on their face. It's more complicated than that.
And here's the absolute key takeaway. You just can't copy and paste one decade onto another. The future is a remix. It grabs elements from different times, the psychology from this era, the government policy from that one, and it mashes them all together into something brand new. Our job, as investors, is to try and figure out which ingredients are in the mix this time around.
This table just shows it perfectly. Look at how different 2002 was. Back in the 30s, you had the government making things worse, which led to a devastating depression. In the 70s, you had people spending like crazy, which led to runaway inflation. But the early 2000s, man, it was this weird, contradictory cocktail. You had the Feds slashing interest rates to get people to spend, but you had shell-shocked consumers who were just too scared to open their wallets. The result? A whole new kind of economic environment that didn't look like the 30s or the 70s.
So, if the old maps are useless, what does the new landscape actually look like? Well, all of this historical remixing leads to a completely different set of rules, a whole new playbook for anyone trying to get through the choppy waters of the early 2000s. Here it is, the new playbook. First, that old buy and hold forever mantra, dead, gone. Second, you had to stop thinking about the market and start thinking about individual companies. It was a market of stocks, where picking the right ones was everything. Third, you needed patience, a lot of it. The analysis was screaming that the next big bull market was years away, not coming before 2005 at the earliest. And finally, the mindset you needed? You had to be nimble, you had to be watchful, and yeah, you had to be a little bit cynical about all the hype. And the underlying message behind all of this was crystal clear. The damage from that bubble was deep. It was structural. This was not something that was going to be fixed with a quick V-shaped recovery where everything just bounces right back. No. This was going to be a long, slow grind. This was going to take time. And that brings us to our final, and honestly, probably the most timeless lesson in this whole thing. How do you operate as an investor when you know the future is murky and the old rulebook has been thrown out the window? We can't forget the giant X factor that was just hanging over everything at the time. The post-9/11 world. The war on terrorism. This wasn't a normal war with clear lines and a clear ending. It created this constant, low-grade anxiety that just weighed on people's willingness to take risks, and that could easily put a lid on the market for years. Which leads us to the real takeaway, the principle that works for any investor, in any era. The point of all this isn't to find one perfect answer and stick with it. It's to build an evolving model in your own head, a framework that you're constantly updating. Because what seems 100% true on a Tuesday might be totally wrong by Friday. The smartest person in the room is the one who adapts the fastest. And look, if you just can't get a read on things, if the picture is too cloudy and your model just isn't working, there is a simple, timeless piece of advice from Wall Street that has saved people's skin more times than you can count. It's not fancy, but it's powerful. When in doubt, get out. Sometimes the absolute best move you can make is just to protect what you have and wait for a clearer day. So I'll leave you with this question to chew on. This method we've walked through, comparing different times, looking for those big psychological shifts, and building a flexible model, it's just as useful today as it was back in 2002. So looking at the world right now, what are the huge economic and psychological forces that you're watching? What historical rhymes do you see playing out? And maybe most important of all, how are you adapting your own model for whatever comes next?
Welcome to The Explainer. You know, we spend a lot of time looking at stock tickers and market reports, right? But today, we're going to explore a powerful idea from an investment guide that flips all of that on its head. What if your most valuable asset isn't actually in your portfolio at all, but it's the very society you live in? Let's get into it.
This quote really frames our whole conversation today. The author's basically telling us, hey, look up from your spreadsheets. He's challenging us to see beyond the daily ups and downs of the market and to look at the huge, complex world that actually gives our money its value. So this is the big question, isn't it? Just forget about market crashes for a moment. The author wants us to think about a much bigger risk. What happens to all your carefully chosen investments if the society that supports them starts to weaken? I mean, what's your money really worth if things like the rule of law or basic freedoms start to fade?
Okay, so what does this mean in a practical sense?
Let's dive into why the author argues that if you're only looking at the financials, you're missing a huge piece of the puzzle.
Here it is, the core idea. We tend to think of money as having this solid, inherent value. But it's not. It's really just a tool, a claim ticket. It's a promise that you can exchange it for goods and services. And the real value of that ticket, well, that depends entirely on the society where you're trying to cash it in.
And this slide just lays it out so clearly. Sure, in pretty much any system, money can get you stuff. But in a free and stable society, that very same money buys you something so much bigger. It buys you a life supported by these incredible, intangible assets. Things like freedom, knowing the laws are fair, and basic human rights. That, right there, is true wealth.
You know, this idea of connecting economics to all these other fields, psychology, philosophy, you name it, it used to be kind of fringe. But the author points out that it's becoming way more mainstream. Even Nobel Prize-winning economists are saying, wait a minute, you can't just separate the market from the culture it lives in. They're all connected.
So, to really get a handle on society's value, we've got to look at the invisible glue that holds it all together. The author makes a pretty interesting argument here, that the order of society is, at its heart, kind of a religious phenomenon, a set of shared beliefs that bind us.
The economist Friedrich Hayek had a fascinating take on this. He argued that it's not just laws on paper that keep a society from falling apart. It's this shared internal vision, an abstract, unspoken set of rules and values about how we ought to live together and what we agree is right and wrong.
And this is where it gets really interesting. Look at the original meaning of the word religion. It comes from a Latin word that means to bind together. Back in the ancient world, it wasn't really about theology. It was about civic duty, kind of like a pledge of allegiance. It was about showing that you were on board with the group's shared values.
The author then makes this really crucial distinction. On one side, you have these belief systems that are like vast, evolving conversations, full of different viewpoints and debates. On the other side, you get modern dogmas that claim to have the one, final, absolute truth for everyone. And it's right there, in that claim of static perfection, that the danger starts to creep in.
And that brings us right to one of the biggest threats the author points to, this incredibly seductive but ultimately dangerous idea of creating a perfect society, a utopia.
The name itself is a dead giveaway, isn't it? When Sir Thomas More came up with the word, he was almost certainly being ironic. By calling his perfect society no place, he was basically winking at us, hinting that a perfect world is something that can never actually exist.
And here is the fundamental problem with every single utopian plan ever cooked up. It tries to force a single fixed blueprint onto a world that is always changing. It's like trying to freeze a flowing river. It's just not going to work.
And there is a massive economic cost to this way of thinking. Hayek argued that progress happens because millions of different people, all with their own unique local knowledge, are out there trying things and making decisions. When you try to control everything from the top down, you snuff out all that individual genius and you kill the engine of progress.
So why are these ideas so tempting? Well, it's pretty simple. They promise easy answers
To the ridiculously complex and messy problems of being human. They offer this alluring shortcut that seems to bypass all the hard work and compromise of real life.
But here's the crucial catch. Anyone who claims to have the one perfect, final answer for how everyone should live, well, that's an incredible level of arrogance. As the author says, they're basically setting themselves up as gods.
Okay, so if chasing a perfect utopia is a dangerous trap, what's the alternative? Well, the author argues that the real answer lies in embracing imperfection and learning to muddle through, which leads to a far more realistic and successful way of building a society.
The author points to the system designed by America's founders as a fantastic example of this. These guys weren't dreamers trying to create a heaven on earth. They were realists.
See, they weren't trying to engineer perfect citizens. Instead, they built a flexible framework designed to manage imperfect ones. Their realism about human nature is exactly why they put in all those checks and balances. They knew that power can corrupt people. The goal was never to force everyone to be good, but to create a system with enough freedom and structure for messy, imperfect people to find their own path and become, as the text says, fully human.
And this quote from Winston Churchill just nails the entire mindset, doesn't it? It perfectly captures the idea it's not about being perfect. It's about being the most resilient, the most adaptable, and frankly, the best option we've come up with so far for navigating the wild ride of human society.
Which brings us right back to where we started. Back to our opening question and what this all means for any of us who are putting our money to work, hoping for a better future.
So,
Being a holistic investor means changing your perspective. It means understanding that your stocks, your bonds, your 401k, none of it exists in a vacuum. It all rests on the foundation of a stable, messy, evolving society that respects freedom and the rule of law. It means knowing that progress is almost never a straight line.
So I'll leave you with this final thought from the author. The next time you open up your brokerage account, just pause for a second and ask yourself, what am I really investing in here? Because your greatest asset might not be a stock or a bond. It might just be the imperfect, free, and evolving society that gives every single one of those things its true value.